I still think it's the politics that are moving things. I'm still convinced that the market is going to eventually have to push back.
If anything was a referendum this election cycle, it's that Americans are supportive of Trump's agenda on tariffs.
I think the market's taking Trump at his word that we have a massive tariff structure. It's going to hurt parts of the economy.
There is a type of momentum that could develop and get things really wrong in the future.
I think there is plenty in the U.S. that keeps the strong growth narrative alive, but we can't take it for granted.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning from New York City. For audiences worldwide, this is Bloomberg Surveillance. Jonathan Ferro and Lisa Abramowitz are off today alongside Danny Berger and Manus Cranny. I'm Anne-Marie Hordern. We do have the equity markets, the S&P 500 hitting a 51 record high yesterday. A little bit of pause, but everyone is starting to double down on their year-end rally. We have a ton of data on deck this week. CPI kicking off tomorrow. We'll also get a lot of Fed speak with Fed Governor Christopher Waller today. So, Danny, a little bit lower today, but the research says the Trump train is going to continue.
Look, it's not ridiculous to take profits after 51 record highs at this moment, but the sell side is all bulled up. Ed Yardeni says that stocks can go to 10,000 by the end of the decade because of Trump's policies. JP Morgan's trading desk, 2024 will be better than 2016. Mike Wilson, stocks can continue their rally post-election. John Stolfus lifts his year-end target to 6,200. Do you need more? Julian Emanuel also saying that the bull market is just getting started. Anne-Marie, maybe the reason to be worried is because of that, because everyone's saying the same thing.
Because everyone's singing from the same tune. And even though there is some pushback potentially, personnel's policy, what does this mean? And maybe a little bit more of an aggressive stance when it comes to China. Matt, is the bond market back open for business after a Veterans Day holiday? And we see yields on that 10-year pushing higher.
Yeah, they are. I mean, the futures prices were lower and there wasn't a huge liquidity yesterday. But this morning we come in, it's the very short end of the curve that has spiked a little bit higher. So here's the discussion with Kathy Jones a little bit earlier from Schwab. What is the fair value actually at the moment? Well, if you raise your terminal rate to around the 4% level, she says actually fair value for bonds at the moment is around 5%. Now, we're still 70 basis points away from there. Where are we on the 10s at the moment? We're 435 at the moment, so we're pretty much 70 basis points away. She says that's fair value, and then you can layer on top the tariffs, layer on top the tax incentives of what will go through Congress, and that's when you begin to really reprice the bonds, which then, Danny, could potentially materially challenge the pricing that's going into some of these calls for the year end on equities.
Nouriel Roubini, though, says the bond vigilantes may curb Trump policies. Market discipline is going to be quite quick. He says Trump cares about market discipline, and if bond yields go higher and the stock market corrects and the bond vigilantes say your policies are unsustainable, with the right economic advisors, they're going to warn him against this. The issue is there's a lot of foreign policy hawks, especially when it comes to China, that have been announced, whether it's Secretary of State potentially Marco Rubio, the senator from Florida, or Representative Mike Waltz. We don't know yet who his economic advisors are going to be.
Yeah, and add to that Tom Cotton, Punchbowl reporting as the Senate Intelligence Committee head. And that's why you see Chinese equities off this morning, even though we had more stimulus coming from them. Do these appointments, Anne-Marie, suggest that there is a priority on China, that having China hawks in the White House in top executive roles is important for the Trump administration?
And if markets are concerned now when they see these names, what's going to happen when they see where Robert Lighthizer potentially is going to be placed? He is the tariff man. All right, let's get a quick check on where we are again with the markets. They are pausing this morning after a 51 record high yesterday, the S&P futures. A lot of people are saying this has to do with politics, but to Danny's point, why not take some money off the table? As Manus brought us through, we have bond yields rising almost 5 basis points, 4.3530 on the 10-year. We do have a stronger U.S. dollar. That has really taken a bite out of oil. That stronger dollar, also the fact that we do have a little bit of lackluster demand when it comes to China. We will get an OPEC report today, so we will see potentially how OPEC and the cartel is viewing supply and demand. We also have Home Depot hitting the wire right now. Danny, what do you see in terms of the health of U.S. home builders?
Look, it's a decline, but it's better than expected. For full year comparable sales, the decline they're expecting is 2.5%. Previously, they saw 3 to 4%. EPS growth, or lack of growth, that is, also better than expected. You can see the immediate reaction in the shares there. The reason that they did better this quarter and the reason that they expect to do better going forward, it's about weather. They're seeing more people shop for seasonal items and certain outdoor projects, which is related to the hurricanes that struck in recent months. So the question here is, okay, this is a good result, but is it only for now? We've had mortgages still go higher. Home demand isn't there. Is this just a one-off because of some seasonal impacts?
Look, the other thing in this stock, and I just caught up with Dasha Afasnavia a little bit earlier, and she said the one thing to watch on this stock is the debt level, and this was interesting. In other words, their debt to EBITDA level is around 2.5 times. They want to try and get that down. The guidance that they're giving in terms of the sales growth, they now expect comparable sales to drop 2.5% for the full year versus the previous guidance, which is 3 to 4%. So this gives them a little bit more headroom. It's a little bit of an improvement in terms of the guidance that we originally had. So that is then pushes into their debt issues for them on that 2.5 times debt to EBITDA ratio.
And many U.S. consumers, as you both brought up, are just waiting to go out, buy homes because they want to see the direction of the Fed, like all of us. And we potentially will get some of that this week. We'll hear from Jay Powell on Thursday. Coming up in the program, Krishna Mueller-Glissman of Goldman Sachs. The stock rally takes a breather. Ed Mills of Raymond James on Trump's cabinet picks. And Tom Steyer of Galvanize Climate Solutions on the energy transition with Trump in the White House. We begin this hour with stocks on pause after 5 days of gains. Treasury yields rising as investors weigh inflation risks under a second Trump administration. Krishna Mueller-Glissman of Goldman Sachs writing, continued increases in bond yields might result in some reflation frustration for equities, in particular if too rapid. Krishna joins us now. Krishna, very good morning to you. Thanks for joining us. How counterintuitive is that? For the past few days, weeks, we've seen a rip-roar in these small caps. At the same time, bond yields remain elevated.
Yeah, no, I think you have a few things that are currently looking a bit weird. I think to some extent there's a lot of growth optimism. You are still somewhat late cycle, and there's no worry about inflation. There's no worry about like rates potentially pushing up too much. And I think we're a bit similar to 2021 in that regard. I remember like initially when the Fed was saying that inflation might be transitory, the market really saw this as a super positive backdrop where rates are anchored, real yields are anchored and possibly going lower. That's very good for equities. That's very good for Bitcoin. It's very good for these type of assets. And there's a very similar template right now. The risk is twofold. First of all, at some point, the market needs to reprice bond yields, and that can be either the speed that the repricing is too fast, and it's already been a big move, or that's the drivers, like that you shift maybe a bit away from break-even inflation to real yields. And that's what we're watching in particular. Our real yields are starting to go up, and that might become a bit of a headwind.
Krishna, I want to stick with small caps, which Anne-Marie brought up so rightly, because in the small cap index, in the Russell 2000, a quarter of firms don't earn enough to cover their interest rates. Surely if we have higher yields, or at least somewhat higher than we're used to, and they don't come down as much, this is not something you can buy. So what wins out? Is it the rate risk, or is it deregulation and everything sunny for small caps?
I think you answered it already to some extent. The market is betting on deregulation. The market is betting on lower taxes, on animal spirits. And we have to consider that some of the financing from these type of small and mid caps might be locked in. They might not directly suffer from rising longer dated rates. And importantly, like currently the expectation, as I mentioned, from market is that, yes, this reflationary shift might make the Fed cut rates a bit less fast, but there's no expectation that rates will actually be increased. I think this is the big risk for next year. If you do actually see the market see inflationary pressures pick up, and you need to reconsider the risk of rate hikes. That seems to be a very high hurdle right now. And I think that's fair that the market is looking at this as a very high hurdle rate. But if you do actually get a shift back to rate hikes, it could really kind of go against that bullish sentiment right now.
Well, all we really have to go off at this moment of what actual fiscal policy will look like is what Trump said on the campaign trail and what his appointments are so far. Krishna, as you're assembling a cross-asset portfolio, how much does it make sense to look at appointments? And let me give you one example. Energy, national security, Mike Waltz, that's what the reports say. And in that, you have an Israel and Iran hawk who has said that Israel should indeed target oil infrastructure in Iran. Krishna, do you look at an appointment like that and say, maybe it's time to go long oil, maybe it's time to price in geopolitical risk? Do you trade off of those types of things at this very moment?
I think as an asset allocator, you want to be very careful about being pushed around too much by geopolitical risk. I think the first line of defense in your portfolio should always be diversification before you actually shift things around, before you actually put on hedges. And I think a well-constructed portfolio that has some real assets in there, that have some inflation protection, maybe you have a bit of energy exposure in some shape or form via equity, via credit. I think that would be the first port of call, maybe avoiding areas that are particularly exposed to the oil price. But I would not necessarily say that it's a good idea to act without any significant details on policies and any more information on the actual appointments getting into the job. It's a bit too early, but I think what I would say, though, is after such a strong rally, what we're discussing with clients is looking into year-end hedges, just locking maybe some of that performance in, selectively trimming, maybe looking more at optionality to stay invested.
Let's just build on that, Krishna. Good morning. You talk about the upside maybe being a little bit contained. What level of containment is it? Because you're still a seller of far out of the money calls, and you want to buy near at the money calls. So just give me a perspective in terms of how far out are you selling, because that's going to be the top end of what you think, of the real extreme of what you think this market can do, and where's at the money that you think we'll get to?
Yeah, I think we are kind of, from a kind of strategist point of view, we are getting close to our targets that we had for the year end and are shooting through those. So I think what we've been recommending, you're right, was to sell maybe far out of the money calls into year end, let's say 10% or so, and buy at the money calls and protect yourself for another 10% rally. But after that, it will be much tougher. I think we have to be clear that there is a real valuation challenge that we're facing for next year. Like Schiller PEs are kind of pushing higher and higher, and I think they were already increasing in the Goldilocks regime, which we had in the last 18 to 20 months. So now they're pushing higher in the reflation regime that we have, because so far bond yields and real yields are not moving higher. So next year we really have a few more headwinds for equity returns, and I think this is where it's coming from, this idea of maybe overwriting far out of the money upside and buying with that shorter dated upside at the money.
Look, you made it very clear that it's a well-constructed portfolio with a few hedges to maybe take profit on what you've seen. Gold is something that you like as an allocation. Now, it's come back, obviously, since the election result came in. You see it more as a geopolitical hedge.
I think you're right. I think gold actually has one of the best track records, one of the best hit ratios to protect you in geopolitical risks, somewhat better than oil. So as you were saying earlier, there is problems potentially related to oil price volatility and uncertainty. Maybe gold will be a better hedge, because gold has other optionalities. I mentioned earlier this kind of reflation where real yields are not going up, this reflation where real yields might actually initially go down because there's a very high hurdle rate for the Fed to actually hike. In this type of setup, gold could be very well supported. And I think there's also a lot of talk about, as I'm sure you heard, the dollar strength being a target of policies around the Trump administration. Again, a weaker dollar is very good for gold. So there's plenty of interesting risk scenarios for the portfolio where gold can help you, so we like gold.
Well, that weaker dollar is not happening today. The Bloomberg Dollar Index hitting its highest level in a year. Christian, some of his policies mean a higher dollar, even if the former president has talked about, the future president, that he would love a weaker currency. We thank you for your time this morning, Christian Mueller-Glissman of Goldman Sachs. Let's get you an update now on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackis. Hey, Yahira.
Hi, Anne-Marie. Lawmakers in Germany have reached an agreement to hold an early election in February. That's according to government officials familiar with the talks, who say the federal ballot, which was originally slated for September 28th, is now expected to be held on February 23rd. The expedited timeline coming after the country's governing coalition collapsed last week when German Chancellor Olaf Scholz fired his finance minister over a long-running dispute about the German economy. Meanwhile, Home Depot's full-year forecast for comparable sales beating estimates. Shares are now higher, nearly 2%. Net sales for the third quarter gaining 6.6% year over year. The CEO saying the company got a boost from better weather with demand for seasonal items and outdoor projects. The company also saying there was added demand after hurricanes struck the South in recent months. The stock is up nearly 20% year to date. And Republicans are inching closer to a full sweep on Capitol Hill. According to the AP, Republicans have won 214 seats in the House to 205 for Democrats. It takes 218 seats to capture a majority. In the Senate, Democratic candidate Ruben Gallego has defeated Republican Carrie Lake, bringing the total to 53 Republicans and 47 Democrats. The GOP is expected to vote on a new majority leader this week. That's your Bloomberg Brief. Anne-Marie?
Thanks so much, Yahira. Up next, Trump's cabinet takes shape.
One of the biggest issues for so many Americans was the economy, and the president was talking about unleashing economic prosperity. Through the EPA, we have the ability to pursue energy dominance.
What personnel tells us about policy? That's coming up next. You're watching Bloomberg Surveillance. Good morning. Equity futures this morning hitting a little bit of pause, but that Trump trade really continues. Look at the research across the street. We hit another record high yesterday. Torsten Slok said a normal year, you get 18 record highs, not 2024. This year has been anything but normal. Yesterday, 51st record this year. Under surveillance this morning, Trump's cabinet taking shape.
One of the biggest issues for so many Americans was the economy, and the president was talking about unleashing economic prosperity. Through the EPA, we have the ability to pursue energy dominance, to be able to make the United States the artificial intelligence capital of the world, to bring back American jobs to the auto industry, and so much more.
Here's the latest. Donald Trump announcing a slew of cabinet appointments. The president-elect is tapping Lee Zeldin to lead the EPA, Mike Waltz as National Security Advisor, and according to CNN, Kristi Noem as Homeland Security Secretary. Sources also telling Bloomberg that Marco Rubio is expected to be announced as Trump's pick for Secretary of State. Ed Mills of Raymond James joins us now for more. Ed, great to catch up with you this morning, especially we're getting a number of personnel announcements coming out of Mar-a-Lago. What do they say to you, especially when it comes to the national security world?
Yeah, Anne-Marie, we're seeing kind of picks coming out in national security, energy, and immigration. If you want to know what Donald Trump's first 100-day agenda will be, look at the team that he's putting together. He is run on this. He is going to lead with this. We are seeing a number of picks that are well-known individuals, at least in Washington, D.C., but also in a number of cases known nationally. So those are the picks that you often lead with, and those are signaling that there are going to be a number of folks that are coming into his cabinet, into his administration, that maybe 6 months ago people would have said, oh, he's never going to get these individuals to join them. He is.
Well, when I look at these names, I definitely think these are hawks when it comes to policy in regards to China. I'm a little bit confused, maybe you can help us out here, about Senator Rubio, because Trump 2.0 was supposed to be a little bit more of an isolationist approach, leaning into the J.D. Vances and the MAGA wing of the party. As far as I'm concerned, Marco Rubio seems to still be a neocon, even if it's a little bit softer neocon.
Yeah, Anne-Marie, I think when you mention kind of hawks to China, I have a hard time finding anyone in D.C. who's not. It's one of those true bipartisan issues in Washington, D.C. Marco Rubio is absolutely known for his aggressiveness towards China, someone that has pushed aggressively to have the tech export controls that we've talked to so many clients at Raymond James over the last 6-7 years. When we look at his record, the record of Elise Stefanik, Congresswoman from New York, Mike Waltz, Congressman from Florida, all of these individuals are individuals who voted for Ukraine aid. This is not that kind of isolation as you talk about. This is a very traditional or more traditional role that Republicans have played in a signal that, yes, there's going to be America first. Yes, there's going to be a very different policy geopolitically that Donald Trump pursues, but the personnel is not as big of a break from some of the rhetoric that we have seen on the campaign trail, not only from Trump, but from a lot of his segregators.
So then that means you're left, Ed, with China hawks, as you say, which perhaps all of D.C. is. If it is indeed true that you have someone like Lighthizer, you have someone who's very pro the style of tariffs that Trump has been championing, and then you have immigration hardliners. And as you say, it shows you what the first 100 days will look like. Does that mean the street has it wrong in being giddy and having high expectations that the focus will be tax cuts and deregulation?
Danny, that's a great question, because one of the things that we've been talking about is what's new, what's deja vu under Trump 2.0. And so we're looking at this, and we absolutely will have trade fights next year. One of the questions I've asked is, there is a brewing trade fight that's going to occur with Mexico, not only on immigration, but the Mexico backdoor that allows China to bring a lot of things into the United States tariff-free. If we're dealing with that, at the minimum, we're going to have volatility. Back in 2016, we saw a major market run after the election. We saw financials really soar. Now, there's a lot of tailwinds right now for financials. A lot of clients are asking me about M&A. That probably continues, but you look over the 4 years, most of that move from financial occurred earlier. So those are the debates that we're going to be having over the next couple of months. What can get continued? And when I look at the majorities in Congress, well, Republicans have likely completed their sweep. In the House of Representatives, when we look at things like taxes, back in 2017, when Donald Trump took over in his first term, there was a 47-seat majority for Republicans. When he takes his oath of office on January 20th, that majority might be down to stuff on a single hand. That's going to be very difficult to govern. You might have the majority, but can you govern is going to be the question in the House of Representatives.
Well, as Anne Marie has said, you might have 218 kings walking around. That can shift policy very quickly. Ed, is this a Republican Party that's more or less beholden to Trump in the second term?
I think it's more, Danny, because when he came into office in 2016, there weren't a lot of natural allies in Congress. In the last 8 years, there's been a massive changeover in the makeup of the House of Representatives, in the makeup of the United States Senate. So there's a lot more natural allies. And to the extent that you look at maybe 218 kings, you also don't want to be the 1 or 2 members who stick their head out and get the full wrath of Donald Trump and his potential support of a primary opponent for those Republicans. It's going to be very difficult to keep that 218 together, that fragile flower of consensus. But Trump being the head of his party is going to be a huge push towards unity in the House, which is not what we've seen over these last couple of years when Republicans have had a small majority, but no leader to coalesce them at the national level.
Good morning to you, Ed. It is, of course, COP29. That's ongoing at the moment in Azerbaijan. And then I look at the Trump pick, Lee Zeldin, to lead the EPA. Energy and drill, baby, drill, along with rolling back some of the commitments that Joe Biden made over COP, are going to be front and center here, aren't they?
Manus, the Trump administration is not going to be a strong participant in future COPs. The Trump administration is going to pull out of the Paris Accords much quicker than they withdrew from previous global climate change accords. That's what he's promised. We look at changes from the Supreme Court on regulation. When we are going to look 4 years from now, there's going to be a significant walking back of a lot of things in the Clean Air Act and the Clean Water Act because of legislative and judicial change. Then we look to Congress, and one of the things that is a low-hanging fruit item is energy permitting reform. A lot of energy projects in the United States take too long to build. The United States Congress is going to speed that up with this Republican majority, but they would have sped it up even if it was a Democratic sweep, because of the AI energy demands that are out there, pushes folks to say, let's get these projects built. And we have the Inflation Reduction Act that provides huge tax credits. So that is actually going to surge over the next 4 years because of the election and also regardless of the election.
Right, Ed, and we do have the Biden administration now in these final days really trying to shore up some of those environmental plans before Trump 2.0 takes hold. Ed Mills of Raymond James, thank you so much for joining us this morning. Keeping on climate and the environment, Tom Steyer of Galvanize Climate Solutions on the clean energy transition under Trump. That's coming up next. You're watching Bloomberg Surveillance. Good morning. A slew of data on deck this week, starting off with CPI tomorrow. We do have equity futures this morning pulling back, but just ever so slightly. This has been a rally for the history books. This factoid got me. This is the S&P 500's best start to an election year since 1936. So everyone's a little bit concerned about potentially what these policies might mean. But Danny, you said it great. The Trump trade continues. You see what Wall Street analysts are doing, what economists like Ed Yardeni are saying. We're hovering around that 6,000 mark. He's saying actually it's going to go higher when it comes to year end. So maybe just taking a little bit of money off the table. In the bond market, we do have the bond market back open for business today, Danny, after Veterans Day hitting a pause. Yields going higher once again.
Maybe this is the true way that they should go. Yields went higher immediately after the election, but they ended the week lower. There is this real concern. We don't know how to model 7 3/4 of deficit being added under a Donald Trump, as is the estimate from the Budget Responsibility Office. If you have that scenario, you have more bond issuance. Will investors be as willing to absorb it? Do you need higher rates on the long end? And what does that mean to have rates moving higher as the Fed is cutting? It's like the opposite of the Greenspan conundrum.
And then when it comes to what's going on in currency markets, our guest just moments ago was talking about the fact that actually Donald Trump wants a weaker currency, but his policies are dictating the complete opposite. The dollar has been strengthening across the board when it comes to G10.
It has indeed. And Kit Jukes from SocGen was with me a little bit earlier on. And ironically, he's of the opinion that we're pretty much nearly at peak dollar. It's going to come faster and quicker than we all think, probably by Christmas time, by the end of the year. I sort of pushed back on that and I said, well, like, why do you think we're going to peak out then? He said, well, take your mind back to 1985. That's when the Plaza Accord was signed. He said Trump is not going to go down that road. He will make a lot of noise about the dollar. He'll make a lot of noise about world trade. But at this stage, Kit was very reluctant to say that he thought it was a 1985 redux where we go for something as grandiose as that, which was the Plaza Accord. It was in Paris. It's not there. And he says if China is going to actually devalue their currency, do it soon, do it quick, do it large. But he doesn't say that's the base case either for China.
Or we get a Mar-a-Lago Accord and everyone will be descending on Palm Beach. All right, under surveillance this morning, Republicans on the brink of taking control of the House. The Associated Press finding the GOP leading 214 to 205 with 218 seats still needed for a majority. The fact that we are still counting ballots blows my mind, but that's where we are. In the Senate, Republicans are set to hold a leadership vote tomorrow. When it comes to the House, what I find so interesting is that Republicans are almost at the brink. But even before they get there, they're going to have to run special elections now because of Donald Trump's policy picks. You have New York Congresswoman Elise Stefanik being clipped from her New York seat. She's going over to the UN. And then you have Mr. Mike Waltz of Florida. This was Ron DeSantis' old seat. He potentially is going to go into the administration. The reports are he'll be the national security advisor. So their majority is getting slimmer every single day, and they haven't even actually got it yet.
And history has shown us that very slim majorities by the GOP in the House has led to a lot of infighting and a lot of struggle to get different legislation passed. The Wall Street Journal had this fascinating story yesterday, basically saying that there's a new dispute rising among the Republican Party, and that is agreeing on what they call the number, and that is the maximum budget deficit that they're willing to pass on. You're going to have this real fight, an interesting fight, I think, play out between the deficit hawks and the tax cutters, between the populists and the sell-side conservative, the conservatives who want to make sure that the deficit is in control. What does that mean? Is it a Trump acting as referee, or is it a real divide between the Republicans?
Or it's the markets. Former Treasury Secretary Larry Summers said the market is going to have to start dictating and educating to lawmakers what potentially it means when you start reaching your fiscal cliff and too high of deficits that maybe the country cannot afford. The darling of the Trump trade has been Bitcoin, and that's nearing $90,000 as traders bet on a boom under President-elect Donald Trump. The overall value of the crypto market rising above its pandemic-era peak. Bitcoin jumping about 32%, Manna, since the U.S. election.
I mean, this is brilliant. The whole value of the crypto world has risen to over $3 trillion. My favorite tweet of all was this morning when I came in and saw the Winklevoss twins coming out. Cameron Winklevoss, one of the twins, the co-founder co-founder of Gemini. Bitcoin has become unburdened by what has been. Of course, he was a contributor to the @real Donald Trump campaign. He gave him $1 million in Bitcoin donations. But, you see this unleashing of if you want to understand the unleashing of animal spirits, it is in the Bitcoin area. We were trying to make it to $90,000 this morning. We didn't quite get there. It's come off. But you're looking at a rally of nearly 30% since the election.
And this is the hope that maybe there'll be deregulation in the crypto world. But I don't see the tea leaves yet that is agenda item 1, 2, or 3 for this Congress.
Can we also just take a step back and talk about the irony of this? Bitcoin is supposed to be like the anti-fiat currency, and it's rallying to near 90,000 on a decidedly governmental process. So maybe the thing we take away from this is like, hey, maybe crypto is becoming more fiat. Maybe we're going to have a national reserve, and like the dream of Bitcoin being something separate from the government isn't as real as we thought.
Listen, there are moments in history when Damascene moments occur, and this could well be one of those under Donald Trump as to whether there is additional credibility. And, does Gary Gensler go? Who replaces that? There are a number of things that can drive the crypto world to new levels as well.
I think almost for certain whether or not Trump was winning or Harris, SEC chair Gary Gensler was on his way out. Outside the United States, China planning to cut taxes for home purchases in its latest fiscal stimulus push. Sources telling Bloomberg regulators are working on a proposal that would allow mega cities to cut the D tax for buyers to as low as 1% from a current level of as much as 3%. This is something, Danny, potentially to try to revive the doom and gloom of the Chinese property market.
Even so, you look at just what Chinese markets are doing this morning, and they're not impressed. Markets have been impatient, waiting for details and stimulus. We also had a package announced on Friday. All of this suggests between Friday and today that China had been waiting to see the outcome of the American election to really start unleashing more stimulus. But perhaps that they are holding back firepower to see what the American policies actually look like. And maybe that's what this market is reacting to, Manis, that there could be more to come, but we need to wait and see what actual tariffs and actual China policy takes form.
And I was itching to know what kind of position the Chinese have in U.S. Treasury bonds. And so I was chatting to James Meg, our correspondent in China, and he said basically it's down $250 billion over the past 3 years. But that has been a slow and incremental burn in a reduction on the reliance on U.S. Treasuries. And indeed, private investors ahead of the election did that. And this is what we're going to talk more about now, which is once the Chinese see the size and the scale of these tariffs, what is the risk then that you will hear this verbiage about the weaponization of China's holding of treasuries? I mean, it's like a drum roll. I've been banging it for like 20 or 30 years. But basically, that is the next thing that you will see stories written about. But that's the slow dissipation, down $250 billion over the past 3 years in terms of holdings.
All right, let's turn back to U.S. politics. Donald Trump's next cabinet beginning to take shape. Trump picking former New York Congressman Lee Zeldin to lead the Environmental Protection Agency. Trump saying Zeldin will, quote, ensure fair and swift deregulatory decisions. They'll be enacted in a way to unleash the power of American businesses. Joining us now is Tom Steyer, former Democratic presidential candidate, of course, and the co-founder of Galvanize Climate Solutions. Thank you so much for joining us around the table. So we're going to get a Trump 2.0. Potentially, they're going to roll back a lot of the work the Biden administration did when it comes to the energy transition. How much does it matter? Because the market is already off to the races.
Well, let's talk for a second about what's really driving the energy transition, which is economics, prices, and markets. Over the last 4 years, solar prices have gone down by 60%. Solar sales have gone up 4x. If you look at what's happened to batteries last year, just in 1 year, they halved in China. The price halved. If you look at what's going on in terms of EV sales, we look at it in the United States, still going up, but not going up that fast. If you look at what's going on in China, they went up 11% month over month. They went up 50% year over year. When you look around the world, what's going on is abundant renewable energy. That is actually the story. What we're seeing in the world is a huge move to renewable energy and the energy transition happening much faster than people in the United States understand, while we're talking about oil and gas, which is basically a stagnant market.
So what does that mean to have a drill, baby, drill policy at a time where you already have peak oil domestic production in the U.S. and you have this transformation you're talking about?
So let's put some numbers on it so that we can really understand what we're talking about. The U.S. is the biggest oil and gas producer in the world. We do about 13.5 million barrels a day. If we do drill, baby, drill, we could take 13.5 and move it to 14 In the context of the world oil market, we're doing about 102 million barrels a day. This is a stagnant market. Even OPEC thinks that the total amount of oil sales will go up by 8% in the next 25 years. Solar sales went up 4x in the last 4 years. So what we're really seeing is an exploding clean energy market. We're not running out of oil and gas, but what we're seeing is an abundance of renewable energy and an abundance of new technologies that are competing on price. I wrote a book, Cheaper, Faster, Better, How We Win the Climate War. And really, that's all we're seeing is market forces. Business. How do you win? Cheaper? It's cheaper. Faster? It's faster and better. And so when we look around the world, governments can't repeal markets. China can't repeal markets. Neither can Donald Trump. What we're seeing is people around the world acting based on prices, what's in their own interest, and what's the best product.
There is another large source of energy demand that's really ramping up quickly besides the renewables, or it goes in tandem with the renewables, and that's the energy needed to power AI. Basically, the amount equivalent to large cities needed to power even just Meta's AI demand. When you look at that and you look at the Trump White House push or the coming White House for deregulation, is there red tape that needs to be cut anyway to allow for this huge source of energy that's going to be needed to power the future?
Of course there is. I mean, when you look at the United States, we are very, very slow in terms of permitting. We're very, very slow in terms of adding new clean energy products or oil and gas projects to the grid. So yes, we have a very slow-moving process because so many people are allowed to weigh in. It just takes so much time. And of course, we should be moving much faster. But when we really look globally about where we're talking AI can move U.S. energy consumption by 20% over the next decade. That's a huge move for us. But if you look around the world, if you see what's happening in Asia, Southeast Asia and South Asia, like in India, it is growing exponentially. They're going to do 5 times as much electricity by 2050, 5 times as much. And so when we really think about what's going on in terms of what's driving prices, what's driving volumes around the world, where the real business is, what we're seeing is it's really in renewables.
And it's interesting, just as we touch on that oil subject, OPEC has released their report. Oil consumption is down 18% since July. This is the 4th consecutive cut that they have in terms of demand, and that's to do with China. I want to focus on one of the things that irks Donald Trump, we know, is other people eating America's lunch. And any move that he makes to step back on IRA, which is done very well in the red states, by the way.
Overwhelmingly in the red states.
Overwhelmingly in the red states. So just how aggressive a pullback is there going to be? Because I can tell you what, there's a lot of European and global CEOs sitting out there who are going, I'm ready to eat your lunch. If you don't want to build this business, we're ready to do it.
Look, that is the point I'm trying to make, which is America has to compete. America, this transition is happening. America should be leading it. This is an absolute necessity for us to be the leading economic country in the world, the leading political country in the world. And I think it's going to be clear, no matter how Mr. Trump feels about what should happen, what is happening is this transition. And American companies can absolutely dominate here. But we have to choose to do it, and we have to put the money into it, and we have to put the manpower into it. So I look at this as a great chance for business, and it's just business. This is just about what is cheaper, faster, and better, and that is traditionally what Americans have done really well at.
Well, then, what level of stimulus could we see from him? What level of incentive could we see for these areas? He's been very, very heavy on the rhetoric against a lot of the incentives that were in the IRA, etc. So how does he temper that? How does he balance this?
I really think that what's going to drive this is American business. That it's not. Of course, the incentives of the IRA were important in terms of deployment of solar, of wind, and the sale of EVs. But the truth is, all of those things are going to keep happening globally. All of those things are going to keep happening in the United States. I mean, if you think about the idea of solar prices going down by 60%, that would be oil going to $32, from $80 to $32. That didn't happen. But you know something? It's not stopping down 60. We'll go down another 60%, and it'll be at the equivalent of $15
Tom,
for a barrel of oil. That's dominance.
If the private sector is doing this already, though, And there was concerns that spending too much at a time when inflation at one point during the Biden presidency hit more than 9%. Then what was the point of something like the Inflation Reduction Act? The former president, future president, continues to talk about that he's happy with clean energy. He has someone like Elon Musk surrounding him, but he thinks it should be driven by the private sector.
It is going to be driven by the private sector. It is driven by the private sector. I think when I think about the Inflation Reduction Act, I think about an attempt to try to subsidize companies that are clean to try and put them on a level playing field with companies that are polluting. That's really how I think about it. But over time, when these prices come down, the need for subsidies goes away. And that's really let me give you one example. Over the last 3 years, Texas has tripled the amount of solar it uses. Texas. They are by far the biggest wind producer in the United States. The 4 biggest wind producers in the United States are all deep red states. They're not doing it because they love the concept of renewables. They're doing it because it's cheaper, because it's good business. And that's what we're seeing is, in fact, cheaper, faster, better. Markets, prices, economics. That's what's driving this world. People are talking, people are saying things, but really what's going on behind the scenes is just, you guys were talking about the dollar. What's driving the dollar? What's driving interest rates? Prices and markets. You can't revoke them. Right. We're in a world where, in fact, we are going a very straightforward way, and we can talk about it, and sentiment can move back and forth. But if you look at the first Trump administration, actually clean energy did really well.
It did.
Yes, there was a lot of rhetoric, there was a lot of anger, there was a lot of emotion, but the fact of the matter is the world just kept powering right through it.
Tom, we thank you for your time this morning.
It's great to see you.
Tom Steyer of Galvanize Climate Solutions. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackis. Hey, Yahira.
Hi, Anne-Marie. An app developed in China is taking Apple to court over the tech giant's App Store practices. A Chinese court agreeing to hear a lawsuit from Beijing Body Reader Technology, which is seeking over $400,000 in damages after Apple pulled their app from their store in 2020. Closed-door hearings in the case may wrap as soon as this week, according to a person familiar. It marks the first time Apple is fighting allegations from a Chinese developer about its platform practices. Meanwhile, a Spirit Airlines plane was struck with bullets as it was landing in Haiti's capital yesterday, prompting the closure of the country's main airport. One flight attendant was injured before the flight from Florida diverted to the Dominican Republic. The company will stop service to 2 of the country's airports, while American Airlines and JetBlue also suspended operations to Haiti. The country is engulfed in political turmoil and struggling to respond to gang violence. Meanwhile, the Jennings Creek wildfire in New York and New Jersey rages on despite Sunday night's quarter-inch of rainfall. According to the New Jersey Forest Fire Service, as of yesterday, the fire was 20% contained, spanning 3,500 acres. But it's not the only one in the area. Several fires burned throughout the weekend along the New York-New Jersey border due to historically dry conditions across the region. No evacuations have been ordered as of yet, but New York Governor Kathy Hochul announced that since the start of the fires, roughly 5,000 acres have been burned. That's your Bloomberg Brief. Anne-Marie.
Thanks, Yahira. Up next, a housing crisis in America.
Look at housing affordability, still a problem. Housing starts are low, building permits are low, existing home sales are low. You have a problem today. Shelters, you're not getting enough home building.
That conversation coming up next. You're watching Bloomberg Surveillance right here on Bloomberg TV. Good morning from New York. Under surveillance this morning, a housing crisis in America.
I think shelter's a really big deal. Look at housing affordability, still a problem. Housing starts are low, building permits are low, existing home sales are low. You have a problem today. Shelters, you're not getting enough home building. You look at all the home builder earnings, pretty rough because they're subsidizing mortgages, they're subsidizing houses through their bottom line. Listen, I think you got to get the rate down. You got to get housing moving. That'll bring shelter inflation down. But that's been the thing that's sticky.
Here's the latest. U.S. mortgage rates hovering near their highest level since July following a 6-week surge. Lingering shelter inflation driven by low supply, high construction costs, having a major impact on housing. Bloomberg's Drew Redding joins us now. And Drew, we also just got a read on the housing market when it comes to the Home Depot earnings report. What are you looking at?
Yeah, so it was a good quarter for Home Depot, a beat and raise on the top line. It looks like they got a little bit of help from the weather and saw some improvement in seasonal categories, as well as a boost from some of the recent hurricane activities. That being said, we still think that the company is likely to communicate during their earnings call that the backdrop for repair and remodeling remains choppy. You still have cautious consumers. You have housing activity, which is at depressed levels, and we're seeing an ongoing pullback in big ticket discretionary spending.
Is there any degree, Drew, where some of this was just put aside because of political uncertainty and consumers wanted to know how things shape up? Already you've seen in risk assets, animal spirits are reawakened. Is that likely to have any sort of read through on consumer appetite for big purchase items?
Well, we have heard from some of the home builders who have told us that in their conversations, buyers, home shoppers were putting off purchasing decisions because of the election. We're a little bit skeptical that the election is causing such a pullback in sales. We think it's really broader economic uncertainty that remains out there, that's leading consumers to pull back. So, we think maybe to some extent we're seeing that, but I don't think that really explains the broad weakness we've seen in housing.
Well, maybe the thing that explains it, Drew, is you had a Fed that cut 50 basis points, and yet you had mortgage rates, which moved higher. Anne-Marie mentioned this, above 7% for a 30-year fixed mortgage at this moment. What does that do to psychology, to consumer psychology, that we got the cut in rates that we wanted, yet long-term rates, mortgage rates, are moving the opposite direction?
Yeah, the fact that we just can't really get any stability in rates, I think, is really impacting consumers. We saw rates come down as low as 6% in September, and we saw a corresponding rebound in housing activity. But in just a couple of weeks, rates were back up 90 basis points. You said 7%, and that puts housing out of reach, home ownership out of reach for many people. Mortgage rates certainly get a lot of attention, and what happens with them will be key in dictating housing demand. But at the same time, you have to remember that home prices are equally as important to that affordability equation. And we've got home prices that are up 50% from pre-pandemic levels. And just to kind of highlight how out of whack home prices seem to be, we did an analysis that shows that in order for monthly payments relative to income to return to historic levels, you'd have to see property values fall about 30%.
Drew, is this also why we have this lack of supply right now in the market as well, on top of the fact that it's difficult for people to get on the housing market?
Yeah, I think part of the supply situation, which has certainly been one of the key themes in housing over the last several years, part of it has to do with the fact that a lot of current homeowners have mortgage rates that are well below the current market rate. A majority of rates out there are actually below 4%, so there's a disincentive to move. But from an inventory perspective, what we're actually starting to see is in some markets in the South, namely Florida, Texas also comes to mind, we're starting to see that inventory reverse. So we do think that could help transaction activity, but we also think that it could put a little bit of pressure on pricing.
Bloomberg's Drew Redding, thank you so much for your time this morning for a look at what is going on with those Home Depot results and the housing market. Coming up next on the program in the 7 o'clock hour, Jim Caron of Morgan Stanley, Terry Haines of Pangaea Policies. We'll look at some of the personnel announcements coming out of Mar-a-Lago. Bob Diamond, former CEO of Barclays, now with Atlas Merchant Capital, and David Tinsley of Bank of America to give a real sense on the health of the consumer. You're watching Bloomberg Surveillance this morning alongside Danny Berger and Manus Cranny. I'm Anne-Marie Hordern.
The Federal Reserve, they have an easing bias. We found that out last week.
We might not get rate cuts as aggressive as the Fed really said just 6-7 weeks ago.
I think that they're really still quite restrictive. I think that they don't want to get ahead of themselves.
I think everyone needs to have a little bit of humility and really focus on the economy and the data.
We have strong growth, we have high inflation, hard to keep cutting.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning from New York City. For our audience worldwide, this is Bloomberg Surveillance alongside Danny Berger and Manus Crenny. Today, John and Lisa are off. I'm Anne-Marie Hordern. We do have a rally, what they're calling for the history books. This is the S&P 500's best start to an election year since 1936. Yes, equity futures this morning are taking a pause, but the Trump trade continues. Yesterday, S&P 500 ending the day hovering near the 6,000 mark. We're nearly close to Ed Gardenny's near-end rally target, which he had to lift because yesterday was the 51st record this year, Danny.
Yeah, Ed Gardenny thinks that equities by the end of the decade, because specifically of Trump policies, can go to 10,000. John Stolfus also had a new street high with 62,000. I thought one of the more interesting calls was from JP Morgan's trading desk saying this is different than 2016 and it will be stronger and a bigger rally because in 2024, it is just the U.S. There's nowhere else to go, especially if there's tariffs. This will be the strength of the American market. The head scratcher, though, is small caps. Yes, that will do better with deregulation, Manus, but a quarter of the Russell 2000 doesn't earn enough money to cover their debts. And that is a problem, and the market is overlooking it.
Yeah, and this is the point that you've consistently made. I like what JP Morgan said. It's basically going to be a home run. It's going to be Team USA until the end. It's going to be a 2016 redux. And the Russell put on 14% between election day and the end of that year. And those small caps only put on 16%. So we've done a lot of the legwork. Oil's in focus as well. We've got OPEC cutting their oil demand. Now, this is fast and furious. This is the fourth month of cuts that they've gone. 2024 oil consumption is down 18% since July. And again, they're referring to the slowdown in their top consumer. You got it, China.
And the price, of course, already has been taking hit. But a lot of that has to do with the Trump trade and the fact that we are seeing absolute strength in the U.S. dollar. The Bloomberg Dollar Index hitting a year high today. On deck this week, we have CPI coming in tomorrow, as well as we're going to be hearing from Fed Governor Chris Waller today. So that's where we are when it comes to the state of play for the equity markets and across asset. Coming up on this program, Jim Caron of Morgan Stanley as the equity rally pauses, Terry Haines of Pangaea Policy as Trump solidifies his border and security picks, and Bob Diamond of Atlas Merchant Capital on the outlook for financials during a second Trump turn. We begin this hour with stocks, as we've been saying, on hold as investors weigh the impact of potential Trump policy. Jim Caron of Morgan Stanley saying this: there are many concerns that Trump 2.0 might lead to a higher deficit, which is ultimately inflationary and could lead to higher yields. This is a risk consideration in markets and is the reason bond yields rose after Trump won the race. From an equity market perspective, we should think about where Trump may be spending as where he may be cutting. Jim joins us now. Well, Jim, let's start there. Where is he spending and where do you think he's going to cut?
Well, thank you for having me on your show this morning. So, look, I mean, it's pretty clear that Trump wants to build a better infrastructure, better energy. I think a lot of those segments of the of the market can actually do relatively well. And where he may start to cut is it's really no specific place, but it's really more of that broad base, Department of Government efficiency type of a strategy, and trying to see where the wasteful spending actually is. So I don't think it necessarily hits a specific area, but I probably would call out maybe healthcare. Healthcare might be an area that could have some reductions because there are a lot of government overlays that goes into that space that goes to fund, some of the pharmaceutical companies and what have you that are based on government financing. So a lot of this is going to be based on the efficiencies in all of these various sectors and really keeping an eye on the outlays and the spending and how that money is being spent, as opposed to just setting forth a policy, putting a dollar number next to it, and then just allowing that to get spent without it being monitored.
The fear of that public debt and the growth of it, Jim, post the Fed cut by 50 basis points, and you add in the strength of the American economy, does mean we've moved something like 60 basis points higher on the 10-year yield since that decision. In Greenspan, the Greenspan conundrum was them hiking rates and the long end rate not going up enough. Here we have the opposite of that, Jim, of rate cuts, and for some reason the long end is moving higher. Could we be in a situation where the cost of capital isn't coming down alongside Fed cuts as we go forward? And what does that mean for this economy?
That's exactly right. I always highlight this, and we say when the Fed cuts rates, do interest rates fall? I mean, it's a mechanical thing that we think about, but we kind of take it for granted. So the reality is that there has been a lot of money supply that's been created over the years. So when the Fed starts to cut interest rates, that money supply is still in the market. Also, if we believe that there is an inflation impulse to higher deficits, bigger balance sheets, and things of that nature, then the Fed may not cut as much. Now, remember where we were. After the September FOMC meeting, the market's priced in that the Fed funds rate was going to 3%. Today, the market's pricing in maybe 3.5%, a little over 3.5%. So there's been a 50 basis point adjustment. And that 50 basis point adjustment in rate expectations from the Fed has translated into the front end of yield curves and is quite naturally flattened the curve. So ultimately, what we need to see is where that terminal policy rate is. Now, I'm of the opinion that the terminal policy rate is going to likely be somewhere between 3.5% and 4%. So I'm higher than maybe what the Fed is saying, definitely higher than what the market is expecting. So 4%, 3.75%. So that would suggest that yields can come down, but they're not going to come down materially from here. But then the next question is will they go up? And unless the Fed switches policy and starts to reverse gears, or we have a big inflation impulse, I also don't think that yields are going to go up quite a bit. So I think it's going to be hard for 10-year treasuries to materially rise above 4.5 or 4.6% for any period of time, unless the Fed reduces reduces their policies. And essentially, what I'm saying is that we're going to have a more broad-based range in interest rates.
Well, that in itself, Jim, just highlights how the broad distribution, how the tails under Trump presidency and the kind of fiscal policy we could get are just really fat and wide, those tails, especially because we don't have any good economic models for what adding $7.75 trillion of debt to the economy would do. What does that mean for the place of bonds in your portfolio in 2025 with that possibility of wide outcomes and higher volatility?
So again, a fantastic point here. So the way that we look at this is that we are perpetually underweight duration. So typically when people say that they're getting towards neutral, they typically get to index level duration in the bond market, which is about 6 years. So for us, the new neutral is to own less duration, therefore to own less bonds. And effectively, our neutral level for duration is somewhere closer to 4.5 or 5 years. So we're a full year shorter, year and a half shorter than what the index might say. So ultimately, what we're saying is that our ability or willingness to buy long-term bonds is less. We're happy to own high-quality, short-term fixed income, and that's where we're going to set it up. Now, the other thing that happens here is that when you get this higher inflation and when we're talking about this duration risk in the markets, you tend to get bond returns correlating very highly with equity returns, which means that bonds don't necessarily hedge equities in the way that they used to do. So therefore, the market, the portfolio becomes riskier because you don't have bonds as that natural offset and that natural hedge. So we have to be very careful and selective and be very actively managed in the bond space as opposed to passive. So it's a change in style, and it's also a change in structure of our overall duration. Less duration, more active management is the way that we're dealing with this right now.
Jim, good morning. If you're reluctant on duration within the bond space, does that carry over into the growth narrative within the equity space, particularly in the Mag 7? And you talk about a mispricing, perhaps, in some of the earnings. I think yesterday our guest from Wells Fargo said he doesn't expect a crash in sort of Mag 7 mega tech, but you've got to reach further and wider into better value in the Russell, into small caps, et cetera.
Yeah, so effectively what we're looking at is more of a broadening out of the markets. So the Mag 7 has done very, very well. That's really largely represented the beta of the marketplace. So think of it as a PE multiple expansion. Is it more about the P than the E? Then it's a beta type of a move, and that's the Mag 7, and that's the large cap, and that's tech, and that's growth. But if it becomes more about earnings are not evenly distributed throughout the S&P 500. You can get earnings in mid cap, you can get earnings in small small cap and also in large cap. So what I'm saying is that going forward, the lines are going to be blurred between large versus small, growth versus value, tech versus non-tech, and things like that. So it's really about, again, moving more towards that active management on the equity side, thinking about where the earnings growth rates are, all the factors of cash flow, free cash flow yields, margins, pricing power, all of these quality factors that can come from different parts of the market. Now, man, there's one risk here, though. The trade that has worked really, really well is that growth in tech space. So yes, it is the Mag 7 that has good earnings upgrades, and a lot of momentum. So we do have to be a bit careful when we step off a train that's been working really, really well for a long period of time, and we have to slowly start to think about reallocating it to the broader markets. And I think that's where some of Trump's deregulation policies can actually help, because I think it would have a better impact on the broader markets more so than just the Mag 7.
When it comes to that deregulation trade, I mean, the idea is that it's going to be within financials, it's going to be within energy. I mean, that's the classic kind of thing that's come into our inbox. To a certain extent, part of that has already been delivered by those two sectors. We really need to know a lot more detail on what deregulation really means for equities.
Yeah, no, and that's a really good point. And the way that I think about this is what they say in the government is that people are policy. So yes, the immediate impact is in places like financials, and sure, and we're going to see that very, very rapidly. But we're also going to see it in the energy sector with permitting. We're going to see it across the FDA. We're going to see it across, various other construction, industrial material sectors, transportation. I highlighted energy, liquid natural gas, all of these other places. We're just going to have different people doing the regulation. So it's not so much about undoing all the regulations. It's just about having different people enforce those regulations, and the interpretation of those regulations might become more business friendly as well. So this is really what we're thinking about. That's much more broad based, and the market is picking this up. The market's figuring this out. The market's saying that it's not just about those specific sectors, because it has been a more broader rally since Trump had pulled ahead in the polls and ultimately won the presidency.
He's definitely been talking about pro-growth policies, but can we have robust growth? We have CPI tomorrow that is not inflationary.
That is the key. That's productivity, right? So high productivity means that you have good growth with low inflation, and we can go from there. So ultimately, that's the solution of what we want. The typical Keynesian way of looking at this is that if you have high growth, you have high inflation. But we're also not accounting for the fact that there could be more business investment. Don't forget, regulation costs a lot. That's a drag on production. That's a drag on profits and also returns. So if you have a combination of smart deregulation, and you also have a reasonable economic environment, reasonable economic climate, and with all the fiscal stimulus that's, by the way, still in the marketplace right now, if you start to deregulate, that money gets to be put towards more productive use. So in theory, yes, you could have more growth with less inflation. That's actually what happened in Trump 1.0 when he was president, when he got elected in 2016. You had a rise in productivity, rise in business investment, because a lot of cash was freed up due to deregulation, and a lot of time and energy that's spent on regulation was freed up to go into business investment, and you can potentially have it. This I think is underappreciated by the market, because it just is a very hard thing to quantify in a specific number.
Jim, we thank you for your time this morning. Jim Caron of Morgan Stanley. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackis. Hey, Yahira.
Hi, Anne-Marie. Democrat Ruben Gallego defeating Republican Carrie Lake in the Arizona Senate race, according to the Associated Press. The win is a bright spot for Democrats after Republicans regain control of the chamber. Gallego will succeed retiring Senator Kyrsten Sinema, who was elected as a Democrat before changing her party affiliation to independent. Though Gallego pulled well ahead of Lake in the entire campaign, in the end, the results were much closer than predicted, another sign of Republican strength throughout the country. Meanwhile, Southwest Airlines offered voluntary departure packages or extended leave to airport workers in 18 cities in an attempt to curb overstaffing. Those who accept the packages will permanently leave the company at the end of the year. This comes as aircraft delivery delays force Southwest to cut its flying plans, and those delays are due to troubles over at Boeing. And OPEC cut its forecast for oil demand growth for the fourth consecutive month and lowered its projection for next year. The move recognizes a slowdown in demand by top oil consumer China. OPEC has scaled back this year's growth projections by almost a fifth since July. Led by Saudi Arabia, OPEC and its allies have twice delayed the restart of production. Modest monthly increases are due to start early next year, but will first need to be reviewed at a meeting in December. That's your Bloomberg Brief. Anne-Marie?
Thanks, Yahira. Up next on the program, bracing for Trump's immigration policy.
With an unemployment rate close to 4% and a population that's aging and all the workers basically not really returning to the labor market, it's not clear at all who is going to be producing that increased output.
If personnel means policy, that conversation coming up next. You're watching Bloomberg Surveillance. Good morning. Equity markets this morning a little bit softer, but still the Trump trade continues. You see a number of members of Wall Street managed just saying, look, we're actually going to be higher. We're not ending the year on 6,000. Ed Yardeni saying 6,100, even though we're a little bit softer today. Bond market back open, though, and yields up nearly 6 basis points.
Yeah, we just had a conversation with Goldman Sachs where Christian Mueller-Glissman called it a weird market, but they're ready to write out of the money calls on this market and, as it were, buy at the money calls. So they think there's potentially another 10% up in this market. Julian Emmanuel says this is a market in its infancy, but then we've got to look at positioning. And Bank of America say the positioning is at an 11-year high. So yes, you can make the argument that exposure at an 11-year high is a little bit stretched. But if you believe in the following, okay, and I'm told that you should, which is tax cuts, you get a tax cut, you get a tax cut, everybody gets a tax cut. We get, a tariff war, and that has implications for the Fed. So maybe some temperance in the rate cuts, but we get growth, Anne-Marie, and growth in earnings. And if that is the situation, then an 11-year high in positioning is not necessarily stretched.
Well, personnel is going to mean policy when it comes to Trump 2.0, and that's what we're going to discuss right now. Under surveillance this morning, bracing for Trump's immigration policy.
If you put tariffs at the same time as you limit immigration flows, it's not clear where the workers are coming from. With an unemployment rate close to 4%, basically with the labor market at full employment, and a population that's aging, and all the workers basically not really returning to the labor market, it's not clear at all who is going to be producing that increased output.
Here's the latest. President-elect Donald Trump tapping Stephen Miller to serve as deputy chief of staff. CNN reporting Trump has also picked South Dakota Governor Kristi Noem to lead the Homeland Security Department. Terry Haines of Pangaea Policy writing Trump's appointment of Stephen Miller as White House deputy chief of staff is at first blush a small markets negative. It raises the potential that staff fights create a situation where Trump's White House loses focus on implementing and executing on markets positive policies. Terry joins us now. So Terry, when you say personnel is policy, based off everything we're hearing out of Mar-a-Lago, what do you think the makeup of Trump 2.0 is going to be?
Well, the short answer is we're not sure yet. But what I would say is this: if you're looking at a second term with a presidential victory, with a tiny House majority and a small Senate majority, broadly speaking, the same as Biden's first 2 years. In context, what you have to look at is, and a lame duck president. What you have to do is maximize your focus on things that are your top priorities, vectored with what's popular first. Secondly, you need to make sure and relentlessly focus on the time left in the administration so that you're pushing that policy forward to success. And thirdly, don't bother with rearranging the deck chairs on the Titanic and a lot of worry about the technicalities of stuff. Just push forward with your most popular things that are your top priorities and move forward.
So far, though, does this not
sorry.
just say to you that this is a hawkish immigration stance and a hawkish stance on China?
Well, sure. No, neither of which are surprises, and both of which are meant to be correctives to much, in their view, in the view, I think, of much of the public, a much wafflier Biden policy. So they will focus on those as priorities, and they should probably.
Terry, good morning to you. Anne-Marie and I were just chatting along with Danny in the break there. And the question becomes, as the construct of this Congress changes, who's going to be the equivalent of Joe Manchin?
Oh, there are a lot of those people. The first two that come to mind are Susan Collins of Maine, Lisa Murkowski of Alaska. But there are others. You know, I've long said, you know, it's a mistake to think of the United States Senate as some unitary body. You're looking at 100 CEOs who are who are making their own decisions in their own interests, and that you need to herd and coalesce in order to get political decisions. It's a consensus body, and consensus is difficult to find. So you need to find those people. But anybody that's anybody that thinks that this is going to operate on the UK model and people fall in under party lines without regard to their own self-interest is, I think, misunderstanding politicians in the United States.
Then that has a direct impact on the evolution of our understanding of tariff, tax, and fiscal policy, because it's not, one team, one dream with no dissent, as you say. So perhaps there is a form of guardrail around the most extreme fiscal, the most extreme tax, and perhaps the most extreme policy.
Well, fiscal's been, fiscal in particular, gets decided much more by the Congress. Most policies get decided in the specifics of them, which markets care about, get decided much more by and in the Congress than in the executive. I think that's not understood. But I was writing on Sunday, and a lot of people have been picking up since. You all discussed it in your last hour. That the shape of the tax cuts and the size of the tax cuts have to do with what the appetite is for increasing deficit, and if so, how much. The last time around, that was $1.5 trillion over 10 years, which sounds like a lot, but when you break it down per year, that was deemed to be an acceptable rise. And this time out, I don't know. I mean, you're going to get a very interesting debate before you ever get to the tax cuts with debt ceiling, debt limit, about what the appetite is, and frankly, what the market reaction to an increase in the deficit is.
Well, the House certainly wants to move a bill within the first 100 days that addresses some of these things. Terry, do you understand the makeup of Congress as it stands at this moment between supply-side conservatives and populists, and where those party lines will fall in ability to agree to what the deficit should actually look like? What, as the Wall Street Journal comes at, is the number that they can agree on?
Oh, I have no idea what the number is. And as I say, I think that depends on, and anybody that says so is not telling you the truth. But, they took until about May of 2017 before there was an agreement among Republicans in the Senate about what that number would be. And the Senate, I think, drives this train this time. The House's job is fundamentally in a Congress in a Washington like this is to stay together as much as possible, frankly, number one. Number two, overshoot. What the House does is always on policy is designed to be too much, with the idea that the Senate brings it back into line, into more of a consensus product. And, that's what they'll do this time. But, my advice to markets is watch the Senate on this, not the House.
Well, speaking of the Senate, Terry, I got 30 seconds. Who's the name you'd put money on when it comes to the majority leader?
Oh, I'd say either Cornyn or Thune. The Scott thing to me is a kind of a last-minute insurgency, and I don't think succeeds. This is a secret ballot, which will tell you everything you need to know. Plus, I think Scott, in his attacks on McConnell and his underwhelming performance at the NRSC the last time, is not beloved by his colleagues.
So it sounds like it's going to be a John. Terry Haines, thank you so much for joining us this morning. Terry Haines of Pangaea Policy. Coming up next, Bob Diamond of Atlas Merchant Capital. Of course, former CEO of Barclays, on the outlook for financials during Trump 2.0. You're watching Bloomberg Surveillance this morning on Bloomberg TV. Good morning. This is Bloomberg Surveillance. John and Lisa are off today. I'm joined alongside the table with Danny Berger and Manus Cranny. As we had another record high yesterday, the S&P 500 hovering near the 6,000 mark. Yeah, we're a little bit softer today, but as Danny keeps reminding us, all the Wall Street notes keep coming out, and they're doubling down on this Trump trade, maybe just taking a little bit of money. The bond market back open for business today after being off for Veterans Day yesterday. And we're seeing yields, Danny, across the curve go higher, especially on 2s and 10s.
There's a huge hesitancy around duration. We were talking with Jim Caron of Morgan Stanley earlier in the hour, who basically said you need to be underweight duration. We've heard this over and over again. Citi, JP Morgan also think that you should be neutral. The concern is whether or not investors are going to be willing to continue to fund the fiscal deficits that America is racking up, especially at a time that you have foreign central banks less willing to buy bonds. You have the Fed doing QT. You now have a situation where there are more price-sensitive buyers. Does this mean we'll see something that looks like a failed auction? Whatever it means, it does mean yields higher, at least for now, even with the Fed that's cutting.
And the dollar moving higher, supported by higher U.S. yields, Manus. At some point, I know you spoke to Kit Jukes this morning, will we actually see parity on euro dollar?
Look, he believes that the political chaos, the tariff potential, and the ECB, the trifecta, it's almost like the horsemen of the apocalypse coming towards the euro. There's an inevitability. You break 105 and you trade down to around parity. But Kit was at pains to say that he thinks that the dollar exuberance and that high will come fast and furious before Christmas, and that's when he thinks you're possibly going to see the dollar peak out. And I sort of pushed him on why you think that is. And he said he thinks the most extreme version of policy on the dollar is not going to be reflective of 1985, which was, of course, the Plaza Accord. There may well be, I loved what you said, Anne-Marie, there may well be a Mar-a-Lago Accord. But right now, he doesn't think the extremes of those dollar policies, those trade initiatives and dollar policies from the 1980s will be brought to bear.
And we're getting a lot of tea leaves and some reporting about how President Trump is going to govern in Trump 2.0. Under surveillance this morning, Trump adding to his list of cabinet picks. He's expected to tap Florida Senator Marco Rubio for Secretary of State after naming former New York Congressman Lee Zeldin to lead the EPA. And according to CNN, South Dakota Governor Kristi Noem is the pick for Secretary of Homeland Security. So two things come to mind when I look at these makeup of people. One, hawkish stance when it comes to China. And then when you look at some of the individuals that are maybe the border czar or the deputy chief of staff, like Stephen Miller, very hawkish when it comes to immigration.
Yeah, very hard line on immigration. And as Ed Mills brought up earlier in the show, does this suggest where Trump's priority is? It is a Wall Street right now that is ecstatic about the idea that the priority of both Trump and Congress will be deregulation and tax cuts. If what we're seeing so far is really concentrated on China hawks and immigration hardliners, is that where the focus is? Will the street be disappointed? Anne-Marie, I think to really understand where this goes and where the priority is, we have to hear who the Treasury pick is.
Oh, absolutely. Treasury pick and also Director of National Economic Council. They're going to have a lot of sway in how the president views the economy, especially operating out of the West Wing. Axios this morning reporting that Israeli Minister of Strategic Affairs Ron Dermer met with Donald Trump at Mar-a-Lago on Sunday. An Israeli source saying Dermer shared messages from Benjamin Netanyahu on Israel's plans in Gaza, Lebanon, and Iran over the next 2 months ahead of Trump's inauguration. Manus, you and I both know that there's been a number of phone calls as well with President-elect Trump and Bibi Netanyahu regarding Iran and how those two view Tehran.
Yeah, and if you think Marco Rubio potentially as Secretary of State, he is not just a China hawk, but he is also an Iran hawk. But he has actually championed maintaining NATO alliances. So it's not all directly negative there. And I think there's a wonderful line from Politico this morning which says, in regards to Rubio, which is, that sign that you hear is a tiny sigh of relief. But there's no doubt about it. It's about a recalibration of what is to be done with Iran. And there was a gathering in Saudi Arabia over the past couple of days about trying to build more of a reconciliation, because, of course, the dial has shifted in Qatar in terms of their negotiating position and stance in this discussion for ceasefire.
And we also know Congressman Mike Waltz, a Green Beret.
Yep.
He will be an individual that Trump is tapping very close to him. It's going to be his national security advisor. These two men are stalwarts when it comes to protecting Israel. They're very hawkish, to your point as well, in Iran. And Netanyahu had come out and said him and Trump see eye to eye when it comes to Tehran. And what I'm hearing is that the sanctions are on the table, and this administration, when they get into power, wants to enforce them. In the corporate sector, Home Depot this morning lifting its forecast for the year after normalizing weather led to strong sales for seasonal goods and demand for outdoor projects. The company also noting impacts of economic uncertainty, hurricanes, and many U.S. consumers postponing home buying and larger scale projects. Danny, you said this earlier, and I thought it was interesting. Everyone was coming on the program saying consumers, big businesses, they're all putting off big purchases until after the U.S. election. So I don't know, we off to the races now because we know the outcome?
Well, it's not like in Home Depot earnings. I mean, maybe it's there. I haven't seen it, saying that all of a sudden over the past week there's been an uptick in interest because we know who's president. The problem from Home Depot, and especially those exposed to the housing market, is that even though you have a Trump presidency, even though you had the Fed cutting by 50 basis points, and again 25 basis points, is that rates have been moving higher. 30-year fixed mortgages have continued to truck higher, above 7%. What does that do to psychology of consumers that were waiting to get home purchases with these event risks off the table, and still you don't have the ability to do it? So sure, Home Depot outperforms, but Anne-Marie, at the moment it looks like a lot of that is due to weather and hurricanes because things needed to be built and replaced. It doesn't suggest long-term success for the company, at least for this moment.
Look, the other two facets, first of all, I didn't help Home Depot personally. I didn't actually get down there. There's a huge one around the corner from here, so no Home Depot for me, but asking other people to help me is there. Look, this is a company with debt, a debt-to-EBITDA ratio of around 2.5 times. Can they pay down the debt? That's going to help them on the stock equity valuation side. But Danny, to your point, which is mortgages are still expensive. If you're not on the mortgage ladder, do you want to take on a mortgage at 7%? It's about the remortgaging market, and we did see a flurry of that in September to the highest level since 2022. But that was, Danny, when we came back down on the rates. And I think for as long as we're in this cutting cycle, there is every opportunity for the remortgaging market to really help you, because that's actually typically how you remodel your home.
I ask this question to myself every day. Do you want to take out a mortgage at 7%? So far, I'm a little bit unsure. All right, financials continue to get a boost from the president-elect's win as investors price in what the Trump trade will look like in 2025. Bob Diamond of Atlas Merchant Capital writing, it's in no one's interest to make the big banks even bigger. We need a vibrant banking sector with regional and specialist institutions that serve small businesses and customers around the country. Pleased to say Bob joins us now, former CEO as well of Barclays. We all know you from our days in London. Thank you for joining us around the table. So what are you expecting in terms of this sector with a new regime in Washington?
Listen, I think it's pretty clear that this administration will be less aggressive on regulation. I think for the big banks, we'll continue to see strong performance. As you just read from my quote, I think the banks, since 2008, when the theme was too big to fail, this won't happen again, the largest 4 banks in the U.S. are bigger. They're more concentrated. They have far more systemic risk if something went on. In our view, the great investment right now isn't just the big banks. And by the way, I think they're going to do absolutely fine. But it's the 4,500 regional and community banks where we think we're going to see consolidation. I think we need consolidation. But more importantly, we need this sector. The service that the regional and community banks provide for small businesses, middle market businesses, family offices, family businesses is much better than the larger banks. I think it's one of the pillars of why the U.S. economy keeps, as healthy and as strong as it is, that it has such a diverse financial services industry. So we do think there'll be consolidation, and we think it's necessary because many of the smaller community banks are frankly too small to succeed. So for us, invest in those really strong regional banks, give them the capital to beef up the capital ratios, whether it's the loan portfolio or the interest rate portfolio, and most importantly, give them guidance, give them the capital so that they can acquire the community banks that are too small to succeed and get the synergies of technology costs, the online type of costs, and all the regulatory costs associated with this.
Bob, if I can pick on one thing you said, because it's a little bit different than the conversation that's been happening over the past few years. The conversation had been where you see some of the risk is the regional banks because they haven't right-sized their rate exposure. You said with the big getting bigger, they have more systematic risk within them right now. What is that risk exactly?
I think it's what the regulators faced in 2008 when banks were so large and it's hard for anyone to imagine today the banks are so healthy and frankly they are pretty safe. They're becoming more utility-like. But if in fact there was a crisis, then the systemic risk of the larger banks is significant. Now, I think more importantly, Danny, is the competition from strong regional banks who are providing the kind of service I talked about, and the competition that they will provide for the big four banks is really good for the economy and really good for customers.
One of the arguments that the banks has left systemic risk is that a lot of the risk is now off their balance sheet and private capital has essentially swallowed that up. And that's where a lot of the riskier loans lay. If we're in an environment with deregulation, do those trends reverse? Do banks start taking on more risk? Does private capital cease the astronomical growth that it's had?
Listen, I think it's not debatable. The banks are larger, they are more concentrated, and if they're the big four, and so they're becoming more like utilities, safer in many ways. But if there were a crisis, being larger and more concentrated is going to create more systemic risk. So I think allowing the growth of the regional banks and the community banks outside of the large banks is really good for the economy.
Look, you've run a major international bank in your time. You're steeped in this business. One of the salivating propositions to the market here in the United States of America is a lighter capital touch.
Yep.
And a softer endgame with Basel III. You've been a CEO, so what is it that moves the needle for the CEOs of the street in terms of capital deregulation?
Listen, it's been very beneficial to the U.S. banks. Manus, you and I have seen this. The UK banks are the opposite extreme. The regulators in the UK have been very aggressive on higher capital levels, very aggressive on not allowing risk or development or growth of businesses. And where are the UK banks now relative to the US banks? Nowhere near. Very low price to book. Very little operations outside the UK. Even my former bank, Barclays, who had the benefit of the Lehman acquisition, has not driven that investment banking business. Given the quality of what they have, they just have not been as aggressive versus the U.S. bulge bracket banks and are paling in comparison. So I do think that the U.S. banks are benefiting from a much lighter touch on regulation, and we see it in the results. Now, I will say, I think it was about 5 or 6 months ago when I was on the show, I think my comment on European banks is I'm becoming less bearish. I couldn't quite say I'm bullish.
Did you phone Andrea Orcel and say get your hands in Commerzbank?
Yeah, but we're starting to see it. Well, whether it's UniCredit and what I think is a very thoughtful approach to Commerzbank, could we see a real cross-border merger? I think that would be
Will the Germans allow it?
I think they will. I think this is a different Germany than we've seen over the last 10 or 15 or 25 years since the introduction of the single currency. They're not really making all the decisions for Europe around banks today. And I have a feeling that this is going to go through and be pretty positive.
Okay, so more M&A cross-border in Europe. Let's spring forward. I can hear Sergio Monti howling at the TV at the moment, going, the landscape's getting even more unfair for the Europeans relative to Wall Street. But let's just cast our view forward. What, in terms of M&A, I hear it from the regional bank, but what about a global M&A bank deal? Is that something that's still not really fit for this landscape, Bob?
Well, I think here's
whether that's Europe to the US or US into Europe, which I think is much less likely.
Here's the rub. I think for bank CEOs, one of the lessons learned in 2008 is that retail banking is a local regional business, and investment banking and asset management and wealth management are global businesses. So absolutely, you're going to see continued growth of the international footprint of the US and European banks in investment banking, in wealth management, in asset management, but I think there's no appetite for a global retail banking operation.
When it comes to some of those regional banks in the United States, are you concerned about the failures we saw last year? And then you have the IMF, Fitch coming out and saying, actually, there is a little bit of concern what's underlying some of these regional banks when it comes to the commercial real estate.
I think I said at the time that the failure of SVB and the failure of First Republic, they were behind us. And I think that the strength of many of these banks, do they need more capital? For sure. Every bank has their treasury portfolio a little bit upside down when rates go from 0 to 5.5%. I think every bank has some issues in the loan portfolio for the same reason. And certainly as an investor, one would stay away from the banks that have a higher percentage of commercial real estate in their loan portfolio. But that's something that can be seen during due diligence. And I see absolutely no crisis brewing out there. I see a much more positive outlook, which is that this is a sector that is absolutely ripe for consolidation, positive consolidation. And my worry is that the noises coming out of the SEC prior to this were a little bit concerned about, do we really want this consolidation? I think it's really, really important for our economy. I think it's really important for these banks. I think the service they're providing is good. And I think this is a really positive case for consolidation. And I think we're going to see more of a positive attitude toward that with this administration.
Let's take one for the street. As an Irishman who's an immigrant, Dodd-Frank, whether it gets changed in terms of the remuneration, do you think that this banner headline of deregulation will incorporate some kind of alteration to the banker bonuses?
Gosh, I haven't heard that word Dodd-Frank in so long. It gave me a little bit of a
Don't worry, shiver. I'm not going to ask you what's on the top
Volcker
page.
rule, is that coming back
No,
as well?
don't worry, I'm not going down there. It's about the restructuring of the bonus remuneration out there on the street, isn't it?
Well, I don't see much pressure on that in the U.S. I actually see that pressure easing significantly in Europe and the U.K. And listen, we all saw it in 2008. The U.S. took a very practical approach with TARP. Re-equitize the banks, force them to clean up their balance sheets, and then, allow them to grow constructively. In Europe, it was a bit more of biblical justice. It was get those bankers and get those banks at the risk of the economies. And we saw it certainly in Ireland for quite a while. I think that's changed. I think the caps on bonuses have even come off to a large degree in the UK just recently. So I think it's moving in a much more healthy direction.
Bob, this was fantastic. Thank you so much for your time this morning. Of course, Bob Diamond of Atlas Merchant Capital, the former CEO of Barclays. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackis. Hey, Yahira.
Hi, Anne-Marie. Donald Trump's return to the White House could see the return of bond vigilantes. That's according to famed economist Nouriel Roubini. In an exclusive conversation with Bloomberg at the UBS Australasia conference in Sydney, Roubini discussed what may happen if Treasury yields surge under Trump.
He cares about market discipline, and if bond yields go higher and the stock market correct, that's a bond vigilantes in the market saying your policies are unsustainable. And if he chooses the right economic advisors, they're going to warn him against policies that eventually have such a market impact and may lead to policies that are more moderate.
Roubini went on to say that investors are still trying to game plan the scope of Trump's second-term policies. Meanwhile, Bitcoin's record-breaking rally continues. Just a few hours ago, it got within striking distance of $90,000. Now it's trading just under $87,000. The currency is lifting the overall crypto market above its pandemic-era peak as traders bet on a boom under President-elect Donald Trump's administration. Plus, with the Republican Party tightening its grip on Congress, that's boosting optimism that the president-elect's crypto-friendly policies will be pushed through. And in sports, the Miami Dolphins held off the LA Rams on Monday Night Football to win their first game in over a month. Tyreek Hill caught a short touchdown pass in the third quarter to end the longest scoring drought of his career. The Miami defense racked up 4 sacks and 2 turnovers and kept the Rams out of the end zone. Elsewhere, the Cleveland Cavs' historic start to the year is not slowing down. Last night's win in Chicago lifted Cleveland to 12-0 to start the season, becoming the first NBA team to do so since the 2015 Warriors. That's your Bloomberg Brief. Anne-Marie?
Yahira, thank you so much. Up next on the program, consumer momentum.
The consumer is interesting because the consumer does seem a little stretched here. Obviously, we've had a great expansion. We've had a phenomenal bull market, so we have somewhat of a wealth effect.
That conversation coming up next. You're watching Bloomberg Surveillance. Good morning. Under surveillance this morning, consumer momentum.
The consumer is interesting because the consumer does seem a little stretched here. Obviously, we've had a great expansion. We've had a phenomenal bull market, so we have somewhat of a wealth effect. Imported consumer goods are going to be one of the places that get targeted. So, without seeing things necessarily, put it this way, even if the consumer's strong, a retailer might be under margin pressure. So I think it's one of those places I think you have to watch and wait.
Here's the latest. Another batch of consumer data due this week, with CPI tomorrow and retail sales on Friday. According to Bank of America's new consumer checkpoint, the consumer shows solid momentum as we head into the holidays. The 2024 Bank of America Holiday Survey suggests people are planning to spend $2,100 outside of typical obligations and necessities this holiday season. That's up 7% year over year. Joining us now, David Tinsley of Bank of America Institute. David, thanks so much for joining us. Read through your report. So let me just get this straight. Are you seeing any signs at all of a consumer that is slowing down?
Yeah, I would tend to take issue with the interview you were just showing there, saying that the consumer looks stretched and is potentially slowing. I mean, in our data, what we're seeing is that our credit and debit card data was up 1% year on year in October. And that's a pretty good number for this data series. And then, of course, if you overlay that with the, I think, 4 months in a row rise in consumer sentiment in the Michigan survey, and then when you look in our data again at what's going on in terms of wages going into people's bank accounts, the year-on-year growth there, I think, is around 2% or so across all income cohorts. So it's not obvious, I don't think, to us that the consumer is slowing. I think we would characterize the situation as continued forward momentum.
David, Anne-Marie and I have been talking about all morning, different companies saying, look, consumers are putting off big ticket purchases until they know the outcome of this American election. Did you see the same pattern in some of the spending, that there's going to be some form of financial firepower unleashed now with the election behind us?
That's an interesting question. So in last month's checkpoint, we did note that we saw some consumer durable purchases, so big ticket items, some slowdown there. So it could be that there is some pent up consumer demand in those sorts of areas. But overall, the position is not a bad one in any case. I mean, what we do see in our data, and I think this speaks to the kind of differential corporate experience, is that the consumer continues to be valuing experiences over goods. So in other words, it's meals out, lodging, airfares, those kind of things are the items of particular strength, more so than on the goods side. So I think that explains some of the differential corporate kind of news flow on this.
David Tinsley, we thank you so much for your time. David Tinsley of Bank of America Institute on the health of the consumer. What I found interesting, actually, is I think this holiday season, there's 5 less days than you normally would see for the holiday cycle. And I wonder if that means potentially there's going to be a little bit less of those Christmas shopping and that spending.
That's an interesting point and reminds me maybe I need to do mine. But for the retailers, they've pulled everything forward. They were scared of strikes. They were scared of weather. They were also scared of elections and tariffs. So they have these stockpiles, and maybe they're more ready than usual for that sped up calendar.
UBS's Paul Donovan always calls it the hedonism of the U.S. consumer.
You watch our show?
Yes, I do. He's always on. Coming up in the program, Richard Bernstein of Richard Bernstein Advisors, former New York Fed President Bill Dudley, and Sonia Meskin of UBS. That's all coming up next. You're watching Bloomberg Surveillance.
I still think it's the politics that are moving things. I'm still convinced that the market is going to eventually have to push back.
If anything was a referendum this election cycle, it's that Americans are supportive of Trump's agenda on tariffs.
I think the market's taking Trump at his word that we have a massive tariff structure. It's going to hurt parts of the economy.
There is a type of momentum that could develop and get things really wrong in the future.
I think there is plenty in the U.S. that keeps the strong growth narrative alive. But
We can't take it for granted.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City for our audience worldwide, good morning. This is Bloomberg Surveillance alongside Danny Berger and Manus Cranny. I'm Anne-Marie Hordern. John and Lisa are off today, and we're still off to the races, I think, when it comes to this Trump trade, even though we are a little bit softer when it comes to equity market futures. Yesterday, though, we did notch another record high this year. Nouriel Roubini, bond vigilantes may curb Trump policies. He cares about market discipline, and if bond yields go higher, which they are, and they are this morning with the bond market back open after Veterans Day, and the stock market corrects, and the bond vigilantes say your policies are unsustainable with the right people around him, he will be regulated by the market.
But maybe it's not the bond vigilantes that do it. Maybe it is this equity market, because we know it is a Donald Trump that cares about equities more. And maybe the team he surrounds himself with will also care about this more. Anne-Marie, you and I were talking about this. The Scott Besson Wall Street Journal op-ed from yesterday basically said, look at what the market is doing. It is endorsing Trump policies. It's a dangerous game to play, though, because as he even says, it is a fickle market, but it seems already we aren't even at day one yet. He's still assembling a team, and they're already benchmarking themselves to this equity market.
Of course, there's everything else we need to look forward to this week, potential catalysts. We are going to hear from Fed Governor Christopher Waller today, and then tomorrow we're going to get the latest inflation data.
Yeah, and we've got the bond market. The cash bond market has come back. It's come back with the bears in charge. We're offered down in price and bid up in yield on the very short end of the curve. And it's ironic because that flattening of the curve that we had last week, Danny, post the election, and the drop in yields net over the week, it allows a re-attack on the upside on yields at the start of this week ahead of some of this Fed commentary. I had a conversation with Kathy Jones from Charles Schwab. She was saying 5% for her is actually a reasonable fair value. Why? Because you raise up that terminal rate up to around 4% and you add in your term premium.
But if you hit 5% on a 10-year yield, can you actually still continue to see these small caps trade in the way they have? Let's take a look at where the markets are trading this morning. As we've said, they're pulling back slightly, but the Trump trade still has that momentum in it. We do have S&P 500 futures hovering around that 6,000 mark. Manus has been talking about this all morning, this quest potentially for parity in the euro dollar. We have seen a much stronger dollar when it comes to the reemergence of a Donald Trump president. 6 basis points now higher on the 10-year yield, and New York crude 68.55. Higher yields, that is taken, and a higher dollar. That means lower oil. Also, this concern about lack of demand coming out of China. Also, when it comes to just the broader equity market picture, JP Morgan talking about in a note that it expects 2024 returns to be larger than 2016. The Trump trade continues, even if we are seeing it pull back just slightly. Coming up this hour, Richard Bernstein of Richard Bernstein Advisors. This is investors worry the rally looks overdone. Well, let's see. Former New York Fed President Bill Dudley on the push and pull between Trump and Fed Chair Jay Powell, who we'll hear from on Thursday, and Sonia Meskin of UBS looking ahead to CPI and PPI. We begin this hour with stocks on hold as markets re-examine the potential impacts of Trump policy. Richard Bernstein of Richard Bernstein Advisors saying it seems highly unlikely that the new administration will exhibit fiscal prudence anytime soon. Tariffs might be an effective trade tool when there is domestic production to protect. However, the U.S. doesn't have nearly enough production to meet demand, so tariffs should be viewed as an inflationary tax because there aren't domestic goods to substitute for the tariff imported good. Richard joins us now. Richard, thank you so much for your time. So when you look at potential Trump 2.0 versus Trump 1.0, what are you expecting from this administration?
So I think right now it's pretty easy to figure out, right? We have a very accommodative Fed. We have a Trump administration that so far doesn't seem to be focusing on fiscal prudence. So if we have stimulative fiscal policy, stimulative monetary policy, we should expect nominal GDP to be stronger than people think, and therefore the stock market and corporate profits will respond accordingly. So I think that's what's going on. I think, you know, my general theme, regardless of whether President Trump is there or whether it was a President Harris, our general theme was that people should expect more inflation rather than less.
Richard,
based on just the notion
if I can jump
that
in there,
globalization
just
is contracting.
Putting all of that together, is the Fed then making a mistake by maintaining an easing bias, if that is the trajectory we're on?
Well, one has to be careful about, you know, like the Fed's not calling me up and asking me my opinion. So whether I think they're making a mistake or not is probably irrelevant. But I will say that this is highly unusual, that the Fed is cutting rates into an accelerating profit cycle. right? Profits tend to spur employment. Profits tend to spur CapEx. And so normally you would find that the Fed is hiking rates into an accelerating profit cycle. Right now they are cutting rates into an accelerating profit cycle. That's putting fuel on the fire, which I think supports the notion that people should be expecting more inflation rather than less.
Richard, let me just say, I don't know what the Fed thinks or who they want to seek advice from, but we want to know your opinion. So I'm glad you gave it to us. I also know that your fixed income portfolio at the moment remains shorter duration than the benchmark. Just how concerned are you about a rise in higher end yields, pain in duration with those fiscal concerns coming online?
Yeah, well, I think, that's been one of our central themes is to be shorter duration than the benchmark because of stronger nominal growth. Really, that's really it. But on top of that, I think one thing that investors really haven't paid enough attention to, and we've written about this extensively, is the United States has been penalized for 11, 12, 13 years now since U.S. debt was downgraded. U.S. Treasuries have consistently sold at a higher yield premium versus AAA-rated sovereigns from other countries. Remember, the United States isn't AAA anymore. So if we saw a downgrade in munis or corporates or anything, we would expect there to be a risk premium attached to it. That has occurred and has been going on in the United States. So there's not going to be a day of reckoning the way people like to talk about. It's more like a slow bleed, and that slow bleed has been going on now for 13, 14 years, sucking capital away from the United States, sucking capital away from productive use.
So does that reverse, Richard? Good morning. Does that long, slow drain under Trump too? Do you think one of his ambitions is to regain market share of manufacturing, but do you think that slow drain of capital inverts and comes back? And what is the impact on that? Because that presumably is a dollar asset positive.
Right. So it's a question, of fiscal prudence. Right? Do we want to raise revenue? Do we want to cut spending? Those are going to be the big things. And part of this is, do we want to reorient capital in the economy to productive use? Look at what's going on right now with cryptocurrencies. I'm not the biggest fan of cryptocurrencies. It's very hard to argue that that's an allocation to productive capital. Like, what does it do for the economy? It doesn't do anything, as opposed to putting it into manufacturing and things like that. So I think we have to be very careful about the notion that everything's going up. We really want it to be oriented towards productive use in the economy.
Okay, so everything's rising at the moment. There's a certain amount of unbridled euphoria in these equity markets, and they're not really looking at the bond markets for now. When we look at the growth trajectory into next year, I looked at the profit for the third quarter. It was 8.4%. It was double the estimate, and the trajectory is for profits to rise going into next year, and that is contingent on growth. And that is the one thing that this Trump administration do not want to see suffers. So with that growth trajectory in mind, do you go further out? Danny and myself and Anne-Marie have been talking about this through the morning in terms of smaller and mid-cap stocks. Is that the ground zero for you to get a better return relative to large cap?
I think that's right. So whenever you have rising interest rates, there becomes a tug of war. Like people say rising interest rates are bad for small cap stocks. That's not really true. Because what happens is when interest rates go up, you get a tug of war between the financial leverage, right, interest rates hurting, and the operating leverage. Why are interest rates going up? Because the economy is stronger than people thought. Nominal economy is stronger than people thought. And smaller companies benefit disproportionately from that increasing operating leverage. So in that tug of war, normally operating leverage wins over financial leverage. It's the same reason why junk bonds outperform when interest rates are going up. Same effect. And so, yeah, I think you want to look at small caps and mid caps. We're quite overweight small caps and mid caps.
Richard, does it make you nervous, though, that everybody's doing that same trade, that everyone's so bulled up on equities, everyone's raising their guidance for the year and jumping in? Is that in itself a reason maybe to be a little hesitant?
Yeah, I think there is any number of different reasons to be cautious right now. People are really bulled up. And the stat that I like to quote all the time is the private client equity beta is now up to 1.45. That is a whopping beta in private client equity portfolios. Monstrous beta. The beginning of the bull market was 0.75. So it's basically almost doubled during the bull market. So people are very bulled up. However, I think if you're talking about equities as an asset class, one has to realize that they're still dominated by the Magnificent Seven. And so, I don't think the risk is equal. I think the risk is disproportionate in those 7 companies. Think of it as a seesaw, if you will. And there's plenty of opportunity on the other side of the seesaw, even though the asset class equities may not do great.
And just looking at some of the measures of positioning, Bank of America say this market is so stretched at an 11-year high. Where do you go for defense? We were talking to Goldman Sachs a little bit earlier on. They're still bullish. They're with the other cadre that Danny has been talking about in terms of the calls for the upside. But where is the defensive play in this? Because the trajectory never remains in a one-way street forever. They were looking at gold. Where do you look for defense in this equity market?
So, Menace, I think that depends on why. If you're worried that the equity market's going to go down, it depends on your view of what's the catalyst that's going to cause the equity market to go down. If you think it's going to be more inflation than people think, a Fed that maybe has to reverse course, getting back to Danny's question before, if you think it's a Fed that has to reverse course, then I think you want more cyclical. They will be more defensive because cyclicals do well in a higher nominal growth environment. If you think it's a fall off in growth, and that we end up heading towards recession, then it would be the traditional defensives, right? You'd want consumer staples and healthcare and utilities and things like that. Right now, we're positioned for the former rather than the latter. We think there's going to be more nominal growth than people think that causes the Fed to kind of hiccup here a little bit.
All right, we will look forward to see what we have a ton of Fed speak this week. Richard, starting with Waller today. Richard Bernstein of Richard Bernstein Advisors. Thank you for your time. Let's get you an update on stories elsewhere this morning. Your Bloomberg Brief with Yahira Hackes. Hey, Yahira.
Hi, Anne-Marie. President-elect Donald Trump continues to fill out his next administration. Trump tapped former New York Congressman Lee Zeldin for EPA administrator, while CNN is reporting Trump will choose South Dakota Governor Kristi Noem for Secretary of Homeland Security. Meanwhile, we're reporting Trump will pick Florida Senator Marco Rubio for Secretary of State, while Florida Congressman Mike Waltz has been tapped for the role of National Security Advisor. And the European Union has notified Apple that its geo-blocking practices are potentially in breach of consumer protection rules. The EU saying the iPhone maker's App Store, iTunes Store, and other media services unlawfully discriminate against European customers based on their place of residence. Apple has 1 month to respond to the findings and propose solutions. Shares are lower. Employees across Wall Street can expect to receive a higher bonus this year. A report from compensation consultant Johnson Associates finding that year-end bonuses across almost all sectors in the industry are set to climb for the first time since 2021. Investment bankers, traders, and asset and wealth management professionals are all set to see increases in incentive pay reaching into the double digits. That's your Bloomberg Brief. Anne-Marie?
Yahira, thanks you so much. We'll get an update from Yahira in 30 minutes' time. Up next, the morning calls, plus former New York Fed President Bill Dudley on the tension between Fed Chair Jay Powell and President-elect Donald Trump. Wall Street Journal this morning saying they visited this 6 years ago, and there is a legal path to make sure he keeps his job. That's coming up next. You're watching Bloomberg Surveillance. Good morning. I'm Anne-Marie Hordern alongside Danny Berger and Manus Cranny. Equity markets this morning taking a little bit of a step back. Citigroup is saying S&P 500 positioning suggests profit-taking possible. Well, of course, that makes sense. We've had a 5-day rally, and yesterday we had another record high. We are seeing the Trump trade continue. Bond market back open for business. 10-year yield up 6 basis points. And the 2-year also hitting fresh highs. We haven't seen these numbers since July. Time now for some morning calls. First up, Evercore raising its price target on Disney to $128 from $105. The analyst expecting improving direct-to-consumer profits. Next up, Morgan Stanley raising its price target on Walmart to $89, expecting a modest upside from earnings next week. And finally, Citi downgrading Ross Stores to neutral, citing increased uncertainty tied to its upcoming management transition. Turning now to the Fed. Former New York Fed President Bill Dudley writing in his latest Bloomberg opinion piece, the U.S. Federal Reserve and its chair, Jerome Powell, are rightly choosing not to act on any assumptions about what Donald Trump might do as president. That said, if he follows through on his more extreme campaign promises, they'll struggle to contain the economic consequences, a problem that equity investors ignore at their peril. Bill joins us now. Bill, you've been in the room. You understand what this is like. Give us a sense potentially of this tension that might brew between the Fed chair and President-elect Trump.
Well, in the short run, there's not going to be much tension because I think the Federal Reserve is still going to cut interest rates a bit further. But longer term, if you look at what President-elect Trump is proposing, higher tariffs, deportations, and fiscal stimulus, that's going to tend to boost inflation, disrupt economic growth because tariffs will force people to reorient their supply chains. And it's going to make the economic environment more difficult. And so the Federal Reserve ultimately is going to react to that. But as Powell said in his press conference last week, we don't assume, we don't guess, we don't speculate. So they're not going to act until they actually see the Trump agenda actually take form. So don't expect any near-term response from the Fed. But in the longer term, I think if Trump does what he said he's going to do, it's going to be a difficult economic ride.
Well, Bill, as you point out, though, if Trump does anything big or abrupt, in your words, the central bank's response will occur too late to mitigate fully the economic impact. So what is the needle to thread to not respond too soon when we don't know the extent of things, but also not waiting too late that you just can't do anything at that moment?
Well, I do think there's a risk that if Trump is very aggressive in terms of his policy choices, that the Federal Reserve will be late. They'll be waiting to see what happens. And then when it does happen, it'll be bigger than expected. And it'll have bigger consequences for growth and inflation. At that point, I think the Federal Reserve would be a little bit behind the curve, and they might have to actually catch up. But that's not a near-term story. That's probably, late 2025, first half of 2026, just at the time that Powell's wrapping up his term as chair.
Good morning to you, Bill. In your opinion piece this morning, you talk about an oddly divergent reaction from the bond market and the equity market. I want to focus on the bond market because it has been a wild ride. And this morning we waken up, again, the birds have been reawakened. The question I would put to you is this. We don't know the tariff. We don't know the tax. We don't know anything about the fiscal policy exactly. We've some broad parameters. When you look at the term premium in the bond market, the debate is how much more term premium there needs to be if there's going to be such a large deficit run. Some of the numbers thrown out there are pretty obscure. But are we on the brink of where there needs to be a lot more term premium to hold U.S. Treasuries?
Well, I think that there needs to be some more term premium to reflect the uncertainty about the economic outlook and the unsustainable fiscal path of the United States. That's one area where Powell actually did speak out last week. He did say that the fiscal path of the United States is unsustainable. And if President-elect Trump does all of the things he wants to do in terms of corporate tax reduction, extending the 2017 tax cuts, the fiscal situation is going to worsen, not improve going forward. So I think the path to higher bond yields is the most likely path. The other thing that's happened, of course, is people have changed their expectations of where the Fed's going in terms of short-term interest rates. A couple months ago, people were expecting the federal funds rate to bottom below 3%. Now the markets are expecting the federal funds rate to bottom at around 3.75%. So if you have a higher federal funds rate, then you're going to have a higher bond yield just by construction.
So the direction of travel, you say, is higher in yields. When you look at the response from Powell at that news conference, and we've touched on this with various people, are we going to hear much more, I don't know what the right word is, aggressive, demonstrative, exacting language from the Fed? What word would you choose that the Fed's rhetoric needs to become more emboldened in 2025?
I think the Fed is actually going to be very, mild in terms of their language. They're going to set monetary policy based on what they think is appropriate given the growth and inflation outlook. And as you noted, it's going to take time for that to manifest itself because we don't really know exactly what President-elect Trump is going to do. So I think the language will be actually not combative at all. You saw last week, reporters asked Powell about, how he can react to the Trump policy mix, and Powell basically said no comment. So I think in the very short term, the Fed's going to keep its head down and conduct policy based on how the economy is doing right now.
But if we can take a step back to the reaction that we've seen here in the now, as you write in your column, you find the stock market response baffling. Equity bulls have been really excited about the prospects of tax cuts and deregulation. What are they missing?
Well, I think that the stock market has this notion that we're going to have deregulation, we're going to have corporate tax cuts, and that's going to boost corporate profit margins. And I think that's probably a fair part of the argument. But I think what they're missing is all the consequences of the other parts of the Trump agenda. Higher tariffs mean higher inflation. They mean disruption, lower productivity growth. Deportations affect the supply of labor. And unsustainable fiscal path means higher interest rates. When I look at the bond market versus the stock market, I think the bond market, as bond yields rise, that's going to put increasing pressure on the stock market. We're starting from a point that the stock market valuations are already extremely high. So if bond yields go up, I think that will weigh on the stock market. I would not be a big stock market bull at this point.
Bill, given that backdrop, how difficult is this December meeting going to be for the Fed?
I don't think it's going to be that difficult because I think Powell laid it out pretty clearly last week. They think that the economy is the risks of inflation and the labor market are roughly in balance. They think monetary policy is still restrictive, so that they're heading back towards neutral slowly. So I think a 25 basis point rate cut in December is still the most likely case. Now, if the economy continues to stay stronger than expected and inflation stays stickier than expected, then that December rate cut might be the last rate cut for a while. But that really depends on the data. The Fed right now is really data dependent in terms of where they're going. The direction of rates is downward, but slowly because the economy is continuing to perform pretty well on the growth side.
Last week, Powell was asked a number of times by journalists about what would happen if President-elect Donald Trump tried to remove him. And this morning in the Wall Street Journal, they talked about 2018. And Powell then went with their reporting to Treasury Secretary Steven Mnuchin and said that he would fight his removal if sought by the president. Are you concerned about the independence of this Fed?
Well, I think you have to always be concerned about the independence of the Fed when you have a president that seems to be a president-elect that seems to be hostile to the Fed's independence. And, the reason why we want an independent central bank is because historically independent central banks actually do a better job in terms of managing monetary policy to achieve the outcomes that we want in terms of growth and inflation. So independence is really driven by the fact that you actually get better outcomes. If people think that the Federal Reserve is going to change course based on pressure from the president, that increases uncertainty and risk. And it also makes the Fed very short-sighted in terms of its policy agenda. So I think the Fed, basically the Fed's going to try to maintain its independence. Powell, I think, was very, very clear last week when asked about whether he's planning to resign early. No. Whether Trump has the right to fire him legally. No. So Powell basically said pretty clearly, I'm going to finish out my term, which ends in May 2026. And so tried to close off the debate on that whole issue.
Not permitted under the law. He kept saying that. No, no, no. And the Wall Street Journal gives some insight into he knows this because he went through it in 2018. Former New York Fed President Bill Dudley, thank you so much for your time and insight this morning. The Wall Street Journal this morning really goes into how Powell went through these motions already when Trump was tweeting at him and John boating him and potentially wanted to get rid of him.
If anything, this gives some confidence. The people that I've spoken to, this is about confidence in that, you might have a verbiage between Powell and perhaps the White House that ruckus will come. But steadfast, and this has got consequences for dollar hegemony. This has got consequences for policy all the way around.
Yep, coming up on the program, Sonia Meskin of UBS and Krishna Memani of Lafayette College as we look ahead to CPI. You're watching Bloomberg Surveillance right here on Bloomberg TV. Good morning, 8:30 on the East Coast. Let's take a look where we are in terms of equity futures. Yesterday, S&P 500 hit another all-time record high. This morning, as Jonathan would say, and he's out. Good morning, Jonathan. No drama. S&P 500 futures still around 6,000. This is as we wait these personnel changes coming out of Mar-a-Lago. But the Trump trade continues when you look at everyone, especially Ed Yardeni saying, you know what, Manis, we're going to see 6,100 year end.
Yep, it's certainly it's up there and it calls a higher level into next year. Some stocks that are actually moving around this morning. Let's just take you through a few of them. We've got Hertz. You need to get out there and rent a few more cars, ladies. Reporting worse than expected losses for the rental car company.
I think we can drive.
I know you can both drive. I know you can both drive. Then keep your eye on this. This is a monster move. We've got Honeywell spiking higher this morning. We have Elliott Investment saying that the activist investor, Elliott Investment Management, building a $5 billion plus position in Honeywell. This is according to people with knowledge of the matter. And they're going to be pushing for, you got it, a breakup and a number of other things in terms of the payout. So keep your eye on that. And let's just close off with Novavax, my apologies. They see revenue 650 million to 700 million. That originally was 700 to 800, so a real pressure point for them there. And in terms of sales, 175 to 225. Again, that is incrementally below the original guidance, Anne-Marie, 275 to 375.
So some movers ahead of the market cash open at 9:30. This morning, investors eyeing this week's data, including CPI, PPI, and retail sales, plus a ton of Fed speak, with Thursday being the big one. We're going to hear from Jay Powell, the Fed chair himself. Joining us now, Sonia Meskin of UBS. Sonia, thanks so much for joining us around the table. So a slew of data this week. What are you looking at?
We are looking at CPI. We do think, obviously, that's important. And something
Inflation still matters?
Inflation still matters. Politics, obviously, front and center. But with the CPI specifically, we expect some, actually, stickiness in the goods sector from the used vehicle prices. And that should persist into the year end and probably into the first quarter of next year. And then there are some seasonal factors that are going to keep inflation a bit sticky. So that is something to keep in mind as the Fed kind of navigates this rather new environment.
Well, over the weekend, we heard from Neil Kashkari that said we want to make sure inflation is vanquished. It's a bit of a different Kashkari, who before had said the labor market is our first and top concern. Do you expect to hear that change in tone more widely from the Fed? We're going to hear from Waller, among others, today. Do you expect them to maybe not sound as dovish as they did in that decision to cut 50 basis points?
You know, the Fed has been saying for quite some time that they're data dependent. And the challenge with that is that you have to react even to some temporary influences in the data, right? You can't just ignore them when you come out and say, oh, we're very data dependent right now. So even though we, for example, and we believe the Fed as well, continue to expect the inflation to slow into 2025 and throughout 2025, barring tariffs, et cetera, and expectations from consumers potentially from that and businesses of higher prices, we still think that they need to somehow acknowledge if inflation is temporarily sticky.
And this is part of your argument that you get another 25 basis points in December time, in the December meeting, and then we continue with a slightly intransigent inflation. Where does that intransigence and stickiness come from? I think one of your colleagues said to Danny and I, Paul Donovan, of course, nobody pays owner equivalent rent, but we do pay, some of us do pay rent. So where does this stickiness come from?
You know, a lot of it, and this is very challenging for the Fed, a lot of it is the seasonal factors. So there's different adjustments that happen pre-COVID and then post-COVID, and some of it is not necessarily felt on the ground as much as it's in the data. And conversely, in the data, sometimes you see things that, or don't see things that are felt on the ground. And it's challenging for them to actually communicate that to an average person, which is another reason why they have to acknowledge even temporary stickiness.
So where do they go then with the guidance in the summary of economic projections in December, which we will get fresh ones? Just how much more of a jolt do you expect there in terms of the guidance for rate cuts or less rate cuts in 2025?
Well, I actually very much agree with William Dudley, whom you had on right before me. They really want to keep their head down right now. They do not want to be in the limelight. They just want to stay on the path that they'd selected before these election results. And then 2025 could potentially bring a lot of changes for them.
But is it not a mistake to at least acknowledge some of it? I mean, part of it feels very odd that they're still talking about the current inflationary environment and things coming down while you have this great fear that's been building in the market of the inflation to come. I mean, you pointed it out. Sure, they can keep cutting if we don't get X, Y, and Z. I mean, those are pretty big ifs at this moment.
Absolutely. But even from the perspective of a Fed observer, they're very difficult to model. We don't know how things are going to shake out. We don't know tariffs, for example, take tariffs. We don't know if they will be imposed. We don't know in what form. We don't know if there's going to be a retaliation. We don't know the impact on business and consumer sentiment. How do you model all of that out? You can model different scenarios, but you can't set policy based on any one of those scenarios right now.
Well, the expectation certainly is that bond yields will be going higher, at least on the long end. Because of that fear, sure, the Fed can kind of bring short end rates down as they're cutting. What does it mean to have an environment for them where they're cutting and the cost of capital is getting higher, where it's getting more expensive to take out loans, it's getting more expensive for mortgages because of the fear of growing fiscal narratives, of growing fiscal deficits?
Absolutely. And this brings us to the question of financial conditions. How do you measure financial conditions, especially when different parts of the economy are facing effectively a different set of financial conditions, right? We know that small businesses are much more impacted by higher rates than larger corporations, for example. Lower income, lower savings parts of the consumer population are also more impacted by higher rates than higher net worth individuals. So the Fed has somewhat of a blunt tool for a bifurcated economy.
The political economy is starting to become a lot more important, it almost feels like, than the central bank. And it's going to be leading the central bank to where they go to next. You're one of the first notes I've seen in a while that is actually talking about the trajectory, the scenario analysis of what we need to pay attention to the start of next year. And you're looking at the debt ceiling, because that's going to kick off in January.
Absolutely, because we believe that this will potentially affect sentiment. If small business owners are not only facing higher rates because the term premium is effectively higher, due in part at least to some of this uncertainty, then the debt ceiling negotiations can potentially introduce even more uncertainty.
Well, it's going to be uncertainty, that's for sure. And potentially we still need the makeup of Congress and how they're going to even deal with a problem like that. Day one agenda item is the debt ceiling. Sonia Meskin of UBS, thank you. Let's take a look where equity markets are. I think, Danny, that point about the fact that the Fed is almost on a different universe. They're looking at an economy that almost might not exist come January because the market right now continuously pricing in Donald Trump's policies, whether that's deregulation, whether that's tax cuts, and whether, of course, that's going to be tariffs. You see right now markets relatively flat after another record high yesterday.
I thought you were going to say that equity markets are also living in another universe alongside the Fed. I mean, we kind of heard it from Bill Dudley there, right? Perhaps one of the first non-bulls we've heard from in some time, that equity markets, and Anne-Marie, I think you said this earlier this week, they're pricing in all the good stuff and none of the bad stuff. We're off to the races, and I got to say, the sell side note after note saying that we can move higher and we are upping our price target.
Maybe pricing in the bad stuff, though, Manis, is the bond market. Yields are higher, 2 years higher since July. There is this concern that there's going to be a tremendous amount of fiscal spend in Washington, D.C. The 10-year yield now up more than 8 basis points.
And look where that movement is on the short end of the curve. That is about recalibrating what you think that the Fed can deliver in 2025. Everybody's talking about a higher terminal rate. You've heard it from a number of people. Kathy Jones said it this morning. I love what Bill Dudley had to say. He would not be a stock market bull at the moment. And the divergent reaction between the bond market and the equity market, not really understanding the equity market's response mechanism. But of course, it's going to come down to, how much term premium do you get to hold U.S. Treasuries? And that is going to be one of the biggest challenges for the bond market participants.
Markets are in the throes of Trump trades. Not my words, the words of our next guest, Krishna Memani, of Lafayette College. Okay, I love this line that you said. They're in the throes of the Trump trade. We see that continuing. Is it sustainable or not?
Well, I think that's an open question. The sustainability of the euphoria in the equity market depends really on the policy set that gets unveiled. And we have ideas, but we don't really know. But at the same time, I think
concepts of a plan
and things that were articulated during the campaign. If all of them come about, then I think the inflationary concerns are real and something that we should pay a great deal of attention to. But it's unclear at this point whether all of them come together as a package. And the Fed is right now saying that they are data dependent. I think in 2025, the Fed is going to be saying that they're data dependent and policy dependent. That's how they will articulate it, because as Powell said, they can't really model whatever is going to come down in a premature fashion. They actually have to see what the details are and then build it in the model. So I think the policy uncertainty is there, and policy uncertainty will continue. At the same time, the euphoria will continue for a while as well.
Well, Krishna, just to pick up on that, because you've got Mohamed El-Erian saying that these are perfectly rational market responses that we have seen so far. Exuberance in equities, one can call irrationality in Bitcoin, whatever, but the momentum is there. What is it that tempers or curbs that? Because the bond market has not done so yet in terms of that rise in the equity market. So what could be the spoiler alert if we're not going to get a 2016 redux between now and the end of this year?
Well, so I think 2016, you have to put the 2016 in the context of 2015, much the same way that you have to put 2025 in the context of 2024. That is, we have had a rip-roaring rally in the marketplace. If it didn't have that, the likelihood of that continue on the back of deregulation, profitability, growth, tax cuts, I think would be real. But we have had a substantial market rally. So, At a fundamental level, things look good. But at a valuation level, when Costco trades at 57 times earnings, you have to kind of ask yourself, how rational is that for a retailer?
Yeah, I mean, well, everybody tells us that the consumer is doing grand, the consumer is doing fine. Tell me this then, the valuation on equities is primarily based on a growth trajectory for 2025. That's what a lot of people have said to us. It's not about rates, it is about growth, and that is what will sustain the upside. So if you come to a situation where you have a dramatically less cuts from the Federal Reserve, what does that do to the growth narrative, and then does that challenge the highlands that we're talking about in these equity markets?
Well, so I would say that the growth drivers are basically native to the economy rather than policy. I think the strategy the strategy that the Fed is implementing is not getting in the way of that growth dynamic. So if you kind of frame it that way, then the underlying fundamental improvement can continue for a little while longer. The real question is that already discounted in things like profitability growth, profit projections, things like that. Yardeni comes up with roaring 20s. I think conceptually that makes some bit of sense. But is that going to be linear, or we basically need to stay here for a while before we go there? I think is a question we ought to be asking.
So if the Fed is forced to stop around 4% because of inflationary policies, can corporate profits and households handle that? Are we in an environment where, given over the past few years, that's going to be okay and growth can continue in that scenario?
So I think if you look at the history, what matters is really long rates far more than short rates. They're correlated, but that's not the driver for the economy. Longer rate, and 4.30 in 10 years is higher than what we are used to at 2%. But in the context of a really good growth environment, is 4.30 so irrational or so detrimental to the growth dynamic? Yeah. And I think that's that's up for debate. I don't think it is going to matter that much, and it's not as restrictive as people think it would be.
Okay, but Krishna, we have this real risk that duration is underpaid, that long-term yields go higher because of concerns about the fiscal deficit. And that is something that's kind of out of the Fed's control. So what happens if financial conditions are tightening and the Fed wants to be cutting, and you have just a long end that they can't control? I mean, kind of echoes of what happened in the UK, maybe not as extreme.
Well, so I think UK is a totally different situation. Sure. Economically, they are in a different place. And I think there is a risk that you have a situation where, because of the fiscal impetus, the long rates continue to go up and the Fed, maybe stalls out at 4%. But I think that combination in and of itself is probably not terrible for the equity market, because on the back of it, you'll probably get growth, and it'll be nominal growth, but it'll be growth, and stocks are nominal instruments, and they'll probably react accordingly.
Look, we talk about the wealth effect and a bifurcated consumer, but if we look at those people who have a mortgage, some people around this desk do, some people around this desk don't. So 50% of US households have fixed their mortgage somewhere around sub 4%. The lucky people, somewhere around 2.5%. That will live long and large in supplanting the COVID money that was there. And that is the other tale that we need to begin to understand. We underestimated the COVID money, and I think we are underestimating the tail of the mortgage boost.
So I think the tail of the mortgage boost and kind of the impact of that on consumer health, you have seen that in all of 2024. That is, despite the fact that new mortgage rates went up, things didn't slow down. What did slow down was the cyclical part of the economy. I think if you look at the housing market, that has been in the dumps for a while, and I think if mortgage rates remain here, that is probably going to remain in the dumps for a little while longer. But consumption, on the back of what you are arguing for, has been pretty decent. So yep. I think that is getting factored in. It's a reality that we have to deal with, but I think the markets have kind of dealt with that for a while.
I just want to end with this, Krishna, of you saying it's hard to stand in front of the freight train of this bullishness, and I think a lot of people feel that way right now. What understanding do you have of just how far we've gone? I know you don't want to step in front of it at this moment, but what looks mispriced to you in the aftermath of the election? Well,
so I think you had asked the question that, how would it end? How would this bullishness end? And I think the way these types of bullish moves end is because they exhaust themselves. That is, it is not because of some catalyst in the market or economy. I mean, that could certainly provide be a driver. But at the end of it, after a while, after everyone has bet on the move, basically there's nobody left. And I think that's the situation we'll be facing in not too distant a future. And then it'll be driven by whatever policies get implemented.
But Krishna, right now, why is the market pricing in all the good stuff potentially we can see from this trifecta in Washington, D.C., and not some of the negative market implications, like a very strict immigration policy, especially look at some of the personnel that the former president is going to be leaning into, as well as higher tariffs?
Animal spirits. There is no kind of, animal spirits are rational, so I can't say they're irrational reactions. But the point is, it is not being driven, or in my judgment anyway, it's not being driven as much by fundamentals. I think the 2024 to late 2023 rally was driven by fundamental improvement. Now it is really animal spirits. And again, they exhaust themselves in due time.
Krishna Memani, thank you so much for your time this morning. Krishna Memani of Lafayette College. Let's get you an update on some of the other stories we're watching this morning. Here's your Bloomberg Brief with Yahira Hackis. Hey, Yahira.
Hi, Anne-Marie. The Biden administration is unveiling plans for the U.S. to triple nuclear power capacity by 2050. This includes constructing new reactors, reopening plants, and making upgrades to existing facilities. These goals could be supported under President-elect Donald Trump's administration. Trump has voiced support for new nuclear reactors to supply power to data centers amid an AI boom. Meanwhile, Tyson food shares are surging in the pre-market, up 5.8% after delivering better than expected fourth quarter earnings. The company said it expects results to improve next year as a turnaround in the chicken business and rising demand for prepared foods offsets losses in its beef category. Still, profits remain constrained by a cattle shortage in the U.S. that is not expected to improve before at least 2026. And online grocery prices declined in October from a year earlier. That's the first such drop since the pandemic. You have to go all the way back to January 2020 to see an annual decline. Data from Adobe that's based on about 1 trillion visits to retail sites and more than 100 million products purchased showed that among the 18 categories tracked, 2/3 of them are now in deflationary territory. Something to watch tomorrow when we get CPI. That's your Bloomberg Brief. Anne-Marie?
Absolutely. Thanks so much, Yahira. Up next, setting you up for the day ahead. Yahira said it there. CPI on deck. You're watching Bloomberg Surveillance. Welcome back to Bloomberg Surveillance. Very good morning to you. We're going to count you down to the opening bell. The trading diary for the week ahead is as follows. This week's Fed speak from Governor Waller. Tomorrow, we'll get CPI plus remarks from Muslim. Thursday, PPI, another round of jobless claims, and more Fed speak from Powell, Kugler, Barkin, and Williams. Plus, Disney reports after the closing bell. And Friday, we'll see the hedonism, as Paul Donovan calls it over at UBS, of the American consumer with retail sales. All of this as Donald Trump solidifies cabinet picks. He's set to meet with President Biden at the White House tomorrow. Joining us now, Bloomberg's Mike Shepard. Bloomberg, what can you tell us about some of these personnel picks? Because as we all know, personnel dictates policy.
Well, you're right, Anne-Marie, and Donald Trump is acutely aware of this based on his first term in office. You'll remember the chaotic first 2 years when we saw all of this turnover and how Rex Tillerson, the former ExxonMobil CEO, didn't really work out as Secretary of State. And likewise, he struck out with his national security advisors at first. This time, he has been much more methodical, but also moved much faster to line up some of his key selections. And those include Marco Rubio for Secretary of State, Representative Mike Waltz to be his national security advisor, and Elise Stefanik to lead the U.S. at the United Nations as the ambassador there. So these are some key picks. We've also seen some, as you alluded to earlier, on the Homeland Security front, looking at the border, looking at immigration, and he's trying to set those people in place. He knows they're loyal. He knows that they're familiar with him and his leadership style and what he wants. And he is ready to try to deploy this day one agenda as quickly and as orderly as he possibly can, in contrast to what we remember back in 2017.
Yeah, at this point in 2016, we were discussing Chris Christie leaving, the chaos that was ensuing. But at this point, Shep, it is the street that wants to know the pick of the Treasury Secretary. How is that race shaping up?
Well, I'm glad you asked that about that, Danny, because we have some news this morning from our colleagues Saleha Mohsen and Jenny Leonard that key advisors to President-elect Trump are leaning towards Scott Bessent. And he is, of course, he runs the money over at Key Square Group. He has also been a staunch supporter of Donald Trump through the campaign, not only doing fundraising, but writing briefing papers and speeches for the former president's campaign. And he has been there really as this kind of anchor when it comes to thinking about and discussing economic policy. And yesterday he published an article in the Wall Street Journal, an op-ed that pointed to how markets were embracing the new version of economics under Trump 2.0 that the administration would like to deploy as policy. And that, of course, is something that would endear himself to the president-elect. He even had a line in that saying, "The dollar loves you." And that is exactly the kind of thing that will win Trump over. But also with Bessent, Trump would get somebody who knows how to speak to the markets. And this is critical because he will want to have someone out there to reassure investors about the stability and direction of the U.S. economy. And he will also need somebody who can speak with authority as he is trying to get his tax cuts and other proposals through Congress.
Mike Shepard, thank you so much for joining us. So when it comes to Scott Bessent, guys, he's actually leading in Polymarket, 83%. It feels like a market endorsement of this individual. And we know that Donald Trump cares about the betting markets because they accurately predicted his win.
Yeah, I mean, what was it? When we sat around the desk yesterday, it was 80%. This morning's gone up by another 3%. But I think to Shep's point, it's about who can speak to Donald Trump in such a way that if you're going to couch these fiscal plans and the other plans and your tariff war plans, and what impact that will have on equity and bond markets.
Danny, you were accurate, though. This is what the street wants to know. Who is going to be the Treasury pick? Coming up tomorrow, Drew Pettit of Citi, Seema Shah of Principal Asset, also Kevin Gordon joining us, and David Kelly of JP Morgan Asset Management. Thank you for joining Danny, Manis, and myself. John and Lisa are off. Lisa will have some interviews for us later in the week. Enjoy your morning. This is Bloomberg Surveillance.
Welcome to a special Nido ATP Finals update for Bloomberg TV and radio from Tennis Channel. Casper Ruud upset Carlos Alcaraz in the biggest shock of the tournament so far Monday. The Norwegian capitalized on a lackluster display from the Spaniard, fighting back from 5-2 down in the second set to close out his 50th win of the year. Ruud reached the final in his previous appearance at the season finale 2 years ago. And don't forget, Tennis Channel's daily live coverage from Turin starts at 5:30 a.m. Eastern.